they don't want to lose a lot of business with them, and they're starting to lose it in United because, again, the complications of adding another type to their fleet, it doesn't even add another type. They're already flying Airbus. It's easier for them to switch, and some of them are starting to do it.
George, competition concerns are always close by in this industry. That's not new. But it's going to be under the spotlight again, I would say, George, now with this. Given there are very few options, what does the regulator do going forward from here? And not just in the United States, I mean worldwide. How do they fix this?
They're already flying Airbus. Well, I mean, I think we're looking for the regulator to help,
George,
shine the light through, maybe is a way to say it, for Boeing, help them put their production, processes back in place. The regulator has to, I think, also be very careful because, this is a U.S. defense contractor. It's very important to U.S. industry, U.S. aerospace, one of the biggest exporters in the country. So it's a very delicate balance they're doing here. But at the end of the day, I think safety has to take the highest priority, and the regulator has to go that way and make the calls based on safety, but they're really trying to help the company through the process more than trying to hurt the company, which is hard.
In the meantime, as we focus on safety and all that, are the Boeing planes currently going for a discount?
There hasn't been a lot of sales. We looked at sales for February. It was a pretty weak month. I think if you stepped up to take an airplane from Boeing today and you were going to bring an order in size, you could probably get a decent price on it.
George Ferguson of Bloomberg Intelligence. You might not get the plane anytime soon, though. George, thank you, sir. Thank you very much. And that right there is the problem.
Yeah, it's a good price, though. I'm thinking of Michael O'Leary. I'm looking at you over at Ryanair looking for a discount.
You'll get a good price, but you're going to pay for it, aren't you? Because you're not going to be able to fly the plane. You're going to have to reduce capacity, which is ultimately what Ryanair's doing.
Which is the reason why this has actually been speculation that prices are going to go up. We heard that from Helene Becker, that actually airline prices could go up. George Ferguson pushing back on that just a bit. But this really is the tension right now, is that it is a duopoly. And one prong of the duopoly is having issues, and both prongs of the duopoly are having issues just to fulfilling the orders to begin with, even before all the problems. Why do we have this duopoly?
Boeing right now down another 1.1%. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The NASDAQ stock market says it has resolved connectivity issues this morning. Pre-market trading on the exchange was disrupted for more than 2 hours. In a statement, NASDAQ says it determined the root cause, but it didn't go into further detail. Bloomberg data shows no trades printed on the NASDAQ global market starting at 4:09 a.m. New York time. The exchange says any unacknowledged orders on its Rash Fix system have been canceled and put back to customers. Donald Trump's economic advisors have floated 3 names to lead the Federal Reserve should he be elected, according to the Wall Street Journal. In a meeting at Mar-a-Lago, Steve Moore and Arthur Laffer recommended Morgan Stanley executive Kevin Walsh, Kevin Hassett, and Laffer himself. Trump hasn't committed to the candidates, but has soured on Jerome Powell, whose chair ends in 2026. A 2-year slump in the second-hand luxury watch market could be nearing an end, thanks to stock market records and the rebound in Bitcoin. The Bloomberg Subdial Watch Index showed prices for the most popular Rolex and Patek models were mostly flat for a second month, with the most in-demand models showing declines of less than 1%. Rolex's GMT remains an outlier, with the blue and red bezel model rising almost 2% in price, selling at more than $20,000 a piece. And that's your Bloomberg Brief. John.
Danny, thank you. Not a fan of that watch at all. I saw you staring at it.
Well, I'm just trying to understand $20,000, and I typically think it has to be, well, I don't know. Have you ever had a $20,000 watch?
No. I thought you never sell Bitcoin. I thought that was the thing. But you do recycle it into Rolex and Patek sometimes.
Yeah.
Apparently.
Well, maybe it's you.
Up next, you don't want to talk about this, do you?
Let's move on.
Okay, fine, whatever.
Carry on.
Investors surrender to higher for longer.
It's more about the terminal rate. We're actually looking for something now north of 4%, which I think is the kind of more interesting next story to play for.
That conversation up next, live from New York City. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder. I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
If you're just joining us, session highs on the S&P 500 up by 0.7%. This equity market's kicking off Monday rallying, and rallying hard. In the bond market, yields are not up to much, up to a lot last week. 429.64 this morning, big move higher by more than 20 basis points throughout last week. Under surveillance this morning, investors surrender to higher for longer.
We just recently changed our call. We had a June start to the cutting cycle from the summer of last year. We've now revised that, looking for 3 cuts this year, but it's more about the terminal rate. We're actually looking for something now north of 4%, which I think is the kind of more interesting next story to play for.
It's the latest this morning. The Fed's next rate decision on Wednesday, with swaps pricing in fewer than 3/4 point rate cuts this year, less than the Fed's median projection in December. James Camp of Eagle Asset Management saying the higher risk to markets is the bond market failing to price in a Fed which may not cut at all this year. James, I'm pleased to say, joined us now for more. James, let's get into this then. What backs up that call? What is your outlook for inflation that suggests to you, at least, that they won't be doing much at all?
Well, John, good morning. I think the issue for the Fed is going to be the inflation data twofold. One is, the base effects, which we've talked about, are going to be difficult. The second is I just think that there's more inertia to inflation in a post-COVID economy than the Fed's giving credit for. And for me, when I look at the growth of the economy, I look at the labor market still being relatively healthy, and I look at the inflation not getting to the terminal rate of 2%, I don't see the cut motivation. I think that's the problem that I'm wrestling with is what is the Fed policy cover, if you will, to be cutting rates when what they're doing seems to be working and yet not quite to mission accomplished.
There are two schools of thought here, James. On one hand, you could say the Fed is going to wait for longer to cut rates, and that's actually going to keep the long end of the curve controlled. They'll keep yield in check, essentially, because they'll get inflation under control. On the flip side, some people will say maybe there's just sort of a tacit agreement to keep inflation around 3% in the U.S. economy, and the Fed's going to cut rates because they're less concerned about inflation actually going down to 2%. Which do you think is most likely based on the communication from the Fed so far?
Lisa, I think the truth is we are in a higher inflation economy for the next decade. I think the Fed acknowledging that, to your point, would be wise. I think that would give the Fed some cover to cut rates. And look, the rate environment is punitive for the lower income. The bottom 80% that are stretched in savings, that are using credit card debt, that are seeing those carry costs go up and up. That is not only an economic risk, frankly, it's a political risk. By the converse, these higher interest rates are actually accretive to some of the large corporations that have issued debt at 3%. So it's It's a very interesting conundrum. I would like to see the Fed come off that 2% terminal rate. I suspect sometime in the early summer we'll begin to get that kind of dialogue, if you will. But I just don't think we're in a 2% inflation world anymore.
Which is the reason why Yuri and Timur of Fidelity came out over the weekend, and I thought this was really notable, saying essentially that the neutral rate has essentially gone between 4 and 4.5% at this point, talking about how the simple math is that inflation, if it settles around 3% and the economy has a soft landing, then the real policy rate should be at least 100 basis points higher than that. Do you agree with that? A 4 to 4.5 Fed funds rate is really what we're looking at for neutral.
I do agree with that, and I think the growth rates and the inflation rates are suggestive that a terminal rate with a 4 handle is likely, and I think the consequences for the long end of the curve, are simply there's going to be less incentive to carry, there's going to be more difficulty in levered trading, and I think the long end of the curve is putting in higher lows, if you will. I don't know that we've breached that 5% 10-year that we had back in October, but investors should be ready and at the switch if we get into a 4.5, 4.75 type 10-year. That's going to be value again, and that's when I think cash should start moving off the sidelines back into the bond market.
Well, let's get into that cash position. So positioning, your 60-30-10, that's stocks, bonds, cash. Is that why you want to retain that option? Have that cash, have 10%?
Yeah, John, I think the cash option is twofold. One is the carry is there, right? We're getting a very handsome yield to weight. The second, I think, more consequential part is the correlation between rates and stocks is very high right now. Until this inflation thing is settled, bonds and stocks trade coincidentally. The yields go up, stocks go down, and vice versa. So we don't want to conflate the risk. I do think the bond market long-term is extremely attractive. History tells us that at a Fed peak, which we were at, that bond market returns for 1, 3, and 5 are unambiguously good. And the other part of the equation is in the dividend aristocrats, those terminal growers, those companies that pay and grow year after year after year, also have a very good track record post-Fed peak. So a little bit of powder dry here in the cash market, but obviously we're being paid to wait.
James, with that in mind, if the correlation is high, why not shift even more into equities versus bonds, or vice versa? Why retain 60-30?
Yeah, I think the one thing that we have to be mindful of is, this could do an about face relatively quickly on us. The yields in the fixed income market are as generous as they've been, in a decade plus. On the equity side, a higher weight we're simply waiting for Brett to get a little bit better. We are, in our companies, having very good earnings growth. We're having very good dividend growth. That's the objective function of an income portfolio. So all things are being checked in those boxes. But in terms of getting even more bullish, if you will, on the equity side, we're just going to have to see some broadening of breadth, if you will.
What do you expect is going to drive that breadth, James? What's going to underpin that?
I think the recognition, especially for the retirees, that the S&P is not their benchmark, if you will, that income and income generation in a lot of the sectors of the economy are doing well. The income growth is there, and that you can buy these companies alongside the bond and the cash markets and probably have the best income environment for the capital markets that we've had in, like I say, 10, 20 years.
We were speaking with Ben Laidler earlier this morning, and he said underpinning this rally, obviously, is NVIDIA. But he thinks that Jensen Huang's speech today, I believe at 4 p.m. Eastern time, kicking off this conference for NVIDIA, is arguably going to be the most important event of the week. Do you agree that this is sort of important to understand the broadening out of a rally hinged on artificial intelligence percolating into the rest of the economy?
I think long wave, yes. I think short term it's a continuation of the momentum trade. Pardon me. The momentum trade is just a huge part of what's going on in the capital markets. The narrowness is obviously a big topic. I'm very excited about AI. We use it in our business. We see it applications, across the economy. The productivity enhancement of these types of innovations can be game changing. The economy, as you know, Lisa, for the last couple of decades has been languishing with productivity growth. I would point to the Fed and cheap money, the longer conversation. But now the cost of capital is higher, and now the companies have to figure out how to get more efficient. Now that labor markets are tighter and labor has a different seat at the table than it's had, these types of revolutions and transformations in technology give us a lot of hope long term. Now, obviously, for markets, it's going to be an exciting week, and those are going to be near-term catalysts. But I think the long-term hopefulness of the economy is that we are going to have a significant shift in productivity and productivity enhancements, which ultimately is wealth creating. So that's a positive.
James, just quick here. I'm wondering, how have you used artificial intelligence? Have you gotten rid of half your employees and just basically stuck computers there instead?
We have not, but what's interesting is we've more than tripled our business over the last 5 years without additional headcount. We've done it more efficiently. Our business is separately managed accounts, which is technologically intensive, and we have algorithms, and we have Bond GPT and other things that allow us to search, to source, and to get accurate price discovery on a very opaque market, which is fixed income. So it's been growing without headcount increase and productivity enhancements really across the board, from trading, research, and portfolio execution.
Hey, James, thank you. Appreciate your thoughts. James Camp there of Eagle Asset Management, finishing up there with AI, looking ahead to that investor conference, that developers conference with NVIDIA, and that speech later on this afternoon. 4 p.m. Eastern time, did you say?
I believe so.
4 p.m.
1 p.m., 1% Pacific time. That's where we're at. Happy Monday.
Got it. Oh, you know, early days. He's excited, I'm terrified.
Really?
Honestly, yeah,
Why?
absolutely. I just don't trust the leadership on these issues at all. I really don't. And when you hear CEOs say things like 3-day work week, everything's going to be great, you'll be more productive, it will enhance your job, I just think job losses. That's all I can think of, job losses.
The bigger fear that I have, because there will be either job losses or just increased productivity, and then you don't have to hire as many people to do as much work, right? So that's sort of what he's arguing. James Camp is saying that they're able to do. What I'm concerned about is skilled versus unskilled. How big that gap gets, because you have to have people who can use AI as a tool. And for people who are flexible to adapt to that and be able to then use that to transform the businesses, what about all the workers who can't? Who are not either trained or don't have the skills to be able to use those tools to then get ahead? That, to me, is a pretty significant.
I have a deeper theory, much deeper, and we don't have the time.
Well, yes, we got
that ultimately
30 seconds.
Capitalism will eat itself. The innovation will be so great, the job losses will be so big that we'll be much more dependent on the state. And that will be the end of capitalism as we know it. Even though this isn't really capitalism, but there should be a pursuit of that.
And humanity. It's
yeah, you know, look, I could go on, but it's Monday and I don't want to make you too depressed. Coming up, Monica DeCenso of JP Morgan, Isaac Boltanski, BTIG, Connie Sam of Sam Consulting.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships. And you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. more and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value in what you're doing in sustainability. Many of our partners have expectations on sustainability.
This is Bloomberg.
Inflation has been more stubborn than expected.
Inflation is an insidious thing. That said, we continue to think it's a second half of the year when we see the rate cuts happen.
While the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
We've been saying for quite some time that the Fed will be slower to lower interest rates.
We are seeing the market really fundamentally reassess the outlook for Fed cuts for this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The first message I received in the commercial break, capitalism will eat itself. Good God, I'm going back to bed. Which I had a feeling that's how people would feel about that. Live from New York City this morning. Good morning, good morning. Massive week ahead. Said that a few times already this week. A recipe for a big week, a dose of NVIDIA, the developers conference kicking off a little bit later this morning, and a sprinkle of central bank decisions. BOJ tomorrow, onto the Fed on Wednesday.
Yeah, I can't really get past this, John. You can't just throw out capitalism will eat itself and then be like, you know, all these really interesting things that are going to be happening.
Power in the hands of the few.
Well, so this, I actually think
becoming more dependent on the state for handouts.
This is the reason why some of these big structural changes do matter. And it raises the question, just to connect back to where you led the show with, which is the Fed and the BOJ and some of these central banking decisions. Are they losing the plot? Are they losing the narrative? Are they losing control over an economic trajectory that is being transformed by other factors, including some of these technological shifts that will lead to perhaps capitalism eating itself?
So we'll strip out AI. Let's talk about the Fed. Is the Federal Reserve losing the plot? Not yet. Has the market? Possibly. Because if you think about how we started the year, it wasn't the Fed that was looking for 3 interest rate cuts this year. It was the market looking for 6 or 7. We've had to take the bulk of that out and do it really quickly in just the space of a couple of months. Is it too early to really change things at the Federal Reserve this week? I think probably. You get a few more months, though, like the months we've seen, January, February, upside surprises, CPI, PPI. Then I think you're going to start to hear a pretty different message coming out of Chairman Powell. Chairman Powell was looking for more confidence about the disinflationary trends of the last 6 months. He was clearly uncomfortable in the news conference at the end of January to say with conviction that the disinflationary trends would continue. A threat to that has been what's happening in goods disinflation. That tailwind has started to pass, and I wonder how concerned they are about that behind the scenes. Whether they talk about that openly and publicly quite so much remains to be seen.
It goes to Mohamed El-Erian's point, which is the concern about not having some larger thesis that's your guiding light. And that when you're so data dependent and the data is noisy and messy and we get so much of it, and it's hard to know which to pick, how do you then get a sense and give the market a sense of forward guidance? When you're basically saying, we don't know, you don't know, who knows? Then how do you get ahead of these things rather than just be subject to the sort of winds that are blowing in different places? This is a big concern. It is fundamentally a policy shift at the world's most important central bank.
The dots don't help them, and I don't think they're going to help them this week either.
I would agree.
Because they're almost constrained by that, held hostage by them. Because they've told us to look at them, and then they tell us they're not that important, and then they tell us to look at them. And you have a median dot right now implying 3 cuts. And I say a median dot implies 3 cuts because that's all it really does. That's not the chairman saying 3 cuts this year. Each individual has their own view on that. Ultimately, I think in a base case scenario for them going forward, they do this piece by piece. We might be getting closer to reducing interest rates. In fact, I would go back to Raphael Bostic of the Atlanta Fed. In an ideal world for him, if the conditions are there, he'd cut interest rates, then wait. And then talk about the next decision further down the road. We've just been drip-fed sort of aggressive transparency at central banks post-GFC, and we expect them to offer us this roadmap, not just for the next few months, the next 24 months, the next 2 years. We want to know where rates are now, what they're coming down to this year, next year, and ultimately where they think the neutral rate is. I don't think they've got a bloody clue where the neutral rate is.
They don't.
Think about where we are right now. They got rates up to 5.5%, unemployment still south of 4%. Inflation surprising to the upside a little bit, but we have seen disinflation. How much of that was down to them? How can they sit there and say we are sufficiently restrictive? Based on what? Based on what? I don't know.
But precisely, right? So this is the question, right? If they don't have any clue, and they're not necessarily going to be able to guide because they don't have a crystal ball and they don't know what the neutral rate actually is, well then, let's say they do that. Let's say they cut once. As we heard from the CEO of Barclays, usually when you start, and then it's a cycle. How do they communicate that? How do they know that? And then when does financial conditions become an issue and a tool for their transmission? If Jay Powell this week comes out and says, I am concerned about how much stocks have rallied, this is absolutely going to move in the opposite direction, will keep us higher for longer, stocks are going to take a hit. They can have influence over that. They just aren't necessarily going to execute that right now.
Can you say bloody on cable?
I think you did great.
Yeah,
I actually thought that was perfect use of bloody.
Sure. Equities right now on the S&P. I think you can. Positive by 0.8% on the S&P 500. In the bond market, 2-year, 10-year, 30-year yields just aggressively higher through last week. A little bit lower this morning, still 4.30 on a 10-year. The euro not doing much, 109 on euro dollar. Coming up this hour, JP Morgan's Monica DeCenso on why she thinks stocks have room to run. BTIG's Isa Boltanski on Donald Trump's plan for 100% tariffs on Chinese EVs. We'll get into that in a moment. And former Fed economist Claudia Sahm are looking ahead to Wednesday's big rate decision. We begin with our top story, the stock market rally hitting pause ahead of this week's Fed decision. JP Morgan's Monica DeCenso saying this: we need to acknowledge the strong start to the year with the S&P 500 now only a few percent away from our year-end 2024 price target. This also argues for more selectivity and being thoughtful if you are still sitting on too much cash. We believe stocks will continue to make new highs. Monica joins us now in New York. Monica, good morning to you.
Morning.
We will make new highs in this equity market. Talk to me about how you'd put cash to work right now then.
The challenge has been everyone's waiting for certainty. You just talked about that. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like. And so the challenge becomes, then what do I do? Do I wait for certainty? Well, anyone who tried that the last couple of years has missed out on a massive rally. And so what we've been advocating to clients is just look at what we can see. Earnings inflecting, right? Put the Mag 7 aside. The other 493, earnings were down last year. We think they'll be up this year. You do have a modest inflationary environment, probably some cuts at some point. That is all good for stocks. Now, I don't think it means another 25% rally, but it is the path to saying maybe 5, 6, 7% from here, which is pretty good after we've already run 7%.
How would you play that? Is that an equal weight S&P 500? Is there a sector preference underpinning that in any way, shape or form?
I mean, the temptation is to say, we'll see the broadening. You got to go outside of the Magnificent Seven. I think it depends where you're starting from. Many people just don't have enough risk on full stop. So if you don't have enough equities full stop, you should be buying broad. If you are over levered to tech, then that's when I would start looking to things like mid cap, where you have valuations that are significantly lower than the S&P, and you have better earnings growth. And you have leverage to things like industrials.
I was looking at your notes, and it was amazing because there's sort of this clarion call from all different financial advisors saying, get out of your cash. Yeah. Why are you in so much cash? Rotate out. You're going to miss out. But you talk about keeping a buffer. What's the buffer?
It depends on what your goals are, right? Like I work with clients across the wealth spectrum, and so you have to just have a plan. I think that's the biggest challenge. Cash has felt good, but the problem is I've seen balances go 20, 30% plus of a portfolio. I think that's too much, really, whoever you are. And so it comes down to what is my plan? If I'm trying to work towards a 10% buffer, you probably have some wood to chop, most people. I would also argue you look at what the market's giving you. Volatility is still exceptionally low. So if you're really that scared about going into equities and risk assets, I would say dip a toe in and then buy a little protection. You're earning a lot on your cash, spend a little bit of that to buy some puts or something like that, just to keep you invested.
There is this issue that the winners have won a lot.
Yeah.
The losers really haven't gone anywhere. You start looking at the winners, I think of, for example, Japanese equities.
Yeah.
Do you pile on, or do you sort of say, you know, there's more downside risk here just based on potential surprises from the Bank of Japan and elsewhere?
You know, it's funny, at the beginning of the year, we did see some rotation out of Japan into areas that looked cheap, like China. I get that, just as a tactical trade, but if you are heavily levered to the US from a risk asset standpoint, and Japan has been underinvested in for decades. I think it's okay to say I need to have a little bit of Japan as a longer term bet. Hard to make a call for 1 to 2 weeks or even a couple months, but I do think there's some reasons to own Japan. Again, very cheap valuations. I think it's like 25% of the TOPIX is under 1 times book value, which seems kind of crazy. And then obviously you have policy shifts coming, reforms coming. Again, that doesn't happen overnight, but it's a reason to have some allocation.
We've been trying to work out what happens to Japanese equities if you do get this move in the Japanese yen. Yeah. And certainly things have been pretty contained because we've had 5 days of yen weakness going into this decision. Dollar yen still in and around 150. But just a little bit of scenario analysis. What would happen if we went from 150, 140, 130, 120? Where does that leave equities? Yeah,
that is clearly a more challenging backdrop, and I think that's the risk. And so some of our clients have been doing this, trying to hedge out the currency exposure when they've been adding to Japan. That's a little bit more complicated. But again, I think that's why the Japan call can't be a 1 month or 2 month trade. You have to say, I want to have an allocation intermediate to longer term to something outside of the US. And I think Japan does look relatively more interesting than, say, Europe right now.
There's this question right now, just taking a step back, whether there's a shift going on under the surface. We saw it last week with commodity stocks outperforming dramatically. Yeah. And it makes me wonder whether we are on the precipice of a reinflating of goods and whether you see that from the increase in activity, not only Japan, but also to some degree on the margins, China and around the rest of the world. Do you lean into that, or do you see that as something that has a sort of self-limiting aspect to it?
We do think, I mean, our outlook for example, Brent, we do think you can see Brent like mid 80s to low 90s. So that does suggest a bit higher from here. That probably is supportive for energy equities. I would remind you, energy equities underperformed last year. That was the one sector that did not do well. And so I think you could see some rebalancing, some addition back there. There's always this struggle too with people who want to get on board with the EV revolution, but then you realize we still need oil in the near to intermediate term. And so I think it makes sense to have some allocation there, especially as we figure out what that transition looks like. But I'm not overly worried that we're going to see oil north of 100, barring some big geopolitical shock. And so I think that from an inflationary standpoint is a little bit less of a risk.
To wrap it all up, I am wanting to know what your take is on Ben Laidler's point that he made earlier this morning. He kind of kicked off the show with this theme where he thinks that NVIDIA's conference, developer conference, is going to be more important than Jay Powell's speech. Do you think that that's true, especially because in some ways the Fed can't tell us all that much because they don't really have a crystal ball?
I think it's probably true for equities this week. If something cataclysmically negative were to happen today, you would see some rotation out of some of these names that have been so heavily owned. That said, I actually think the tone's probably going to be pretty positive, and you're going to hopefully hear some commentary about how this is not just an NVIDIA story. It's a broad story for the market, for the S&P, for companies that will become more efficient. I know us at JP Morgan, we're using AI everywhere. It's a huge part of all of our conversations and how we can become better advisors, more efficient, quicker, faster. Doesn't mean we're not hiring. It just means hopefully I'll get better at my job and I can do more.
You don't think it ends capitalism?
Not today.
No?
Tomorrow. Longer term, maybe it's a different question, but we'll still be here next week, I think.
Monica, I hope so. It's good to see you. Monica DeCenso, JP Morgan Private Bank. I was looking through the winners and the losers of the S&P 500 year to date. Top of the pile, I'm sure many of you know this, Supermicro Computer up by 276% year to date. Also looking at NVIDIA up 77, that's number 2. Bottom of the pile, Tesla, Boeing. 2 stocks in a bad place this year.
Boeing because it's one catastrophe after another, and Tesla because there's a real sea change in the idea around electric vehicles. Did you read about the Hertz CEO who left after the disaster? There, I was reading about the resale value of electric vehicles. It's very minimal, just simply because the battery only exists for 8 years. So if it's only 8 years, and that's the bulk of all of the value in the car, and you have to replace it, you don't get the same kind of resale value as when you've got an engine and you've got all the parts, and et cetera, et cetera. This, to me, is a really significant issue.
No confidence around battery degradation at all, and trying to work out what that secondary market price should actually be. Just on the weekend, can I just say this before we move on? I found the weekend really frustrating. I found it really, really frustrating.
Couldn't tell.
I was thinking back to how the media had covered the former president before, and it always annoyed me. And then they repeated it again this weekend. The comments about there being a possible bloodbath if the former president didn't win this election. I think you always have to mention the context of which those particular comments were made, and then you can make up your own decision. It's not for me to tell you how you should view them. What annoyed me about the weekend was not only the absence of any mention about the auto industry, but the failure to respond to the policy that was actually being mentioned in that address by the President of the United States, the former president, talking about a 100% tariff on automakers out of China in Mexico, So you've got to start thinking about the potential for that policy to become real and not just staying there, but maybe spreading. And once again, over the weekend, just totally failing to focus on the policy and just to go with the sentiment and the clickbait of the headline. And it just gave me a sense that we're going to repeat the same mistakes we made last time around covering this president.
I want to stand up and clap. I think I should. You know how I feel. I completely agree with you. The policy, let's talk about that. Why are we focusing on the noise and the theater of it? Let's move on. I think you're absolutely right.
I know there's a home bias, but I have to say, you know, just to endorse the team here at Bloomberg, the headline was the potential 100% tariff, and then the other stuff, bloodbath, is mentioned in the body of the story. I mean, that's how you should do it. But hey, equities right now on the S&P 500 up by 0.8%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden is preparing the toughest ever pollution limits on American cars to accelerate EV sales. Speaking of, the EPA will finalize the limits in the coming days. The idea is that it will help the U.S. meet the Paris Climate Agreement commitments. It is a political balancing act, though. Biden is trying to court voters in the swing state of Michigan, including auto workers who are often uneasy about the quick transition to EV. Apple is in talks to build Google's Gemini AI engine into the iPhone. Sources say the two companies are in active negotiations to let Apple license Gemini to power new iPhone features this year. For years, Google has paid Apple billions of dollars to let it be the default search engine on its Safari web browser. The cocoa rally shows no signs of slowing. It's doubled in less than 3 months and is now trading at a record high. West African crops have been battered by diseases and extreme weather. The rally accelerated just ahead of Easter, where a lot of people buy chocolate and chocolate eggs in many countries. Now the price surge is starting to bite at the grocery store. And that's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, Trump doubling down on Chinese tariffs.
We're going to put a 100% tariff on every single car that comes across the line, and you're not going to be able to sell those cars. If I get elected, now if I don't get elected, it's going to be a bloodbath for the whole, that's going to be the least of it.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good good data. We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Just you and me this week, flying solo. TK took the week off.
Yep.
He's gone on vacation.
Yeah, I got a message from him.
AMH is threatening to take the whole week off.
They're all on vacation. They're all leaving us.
Yeah, skipping the Fed meeting apparently. Equity futures on the S&P positive by 0.8%. Session highs this morning, this Monday morning to kick off a trading week. Equities pushing higher after some very mild losses last week, down about 0.1%. In the bond market, yields just about unchanged, 430.63 on a 10-year. Under surveillance this morning, Trump doubling down on Chinese tariffs.
If you're listening, President Xi, and you and I are friends, but he understands the way I deal, we're going to put a 100% tariff on every single car that comes across the line, and you're not going to be able to sell those cars. If I get elected, now if I don't get elected, it's going to be a bloodbath for the whole, that's going to be the least of it. It's going to be a bloodbath for the country. That'll be the least of it.
Here's the latest this morning. The Republican nominee threatening to slap a 100% tariff on Mexican-made Chinese EVs if he wins in November. Joining us now is Isaac Boltanski, Director of Policy Research at IG. Isaac, before we even get into how this would work in practice, can we talk about how this is playing in Detroit, Michigan? How is this playing?
Yeah. Look, I think that we need to understand that this is a very, very long general election. It's going to be the longest general election ever. And we still have 231 days of this left ahead of us. And I think that we need to understand why the former president was saying what he said and where he said it. This was to play in Ohio and Michigan. And I can tell you, going through the local papers in Michigan and Ohio, which is something we try to do to try to understand how these swing states are looking at developments on the campaign trail, it's playing pretty well in Michigan today. And I think that one of the things you're going to see, John, over the next few months is you're going to see both of these candidates trying to go after union workers. So look, this Trump commentary on 100% tariff on EVs, this is something that is meant to play to the manufacturing base in Michigan and Ohio. It's the same reason that you've seen President Biden change his tone and become more aggressive on the U.S. Steel deal. These are all politically motivated dynamics, but each of them have real market implications.
It looks like they're going to go at things slightly differently, though, Isaac. At the moment, the administration is looking at the supposed national security threat of Chinese EVs. The president's coming straight out and just saying, the former president, we're going to put a 100% tariff on them, even if they're made at the border in Mexico. Isaac, can you tell me how that would work in practice? Can they basically discriminate against one manufacturer from one country in Mexico?
So look, there are always hurdles here, right? And we need to understand that there is a chasm between rhetoric from the campaign trail and the reality of implementing policy. But ultimately, when we cut through the noise, I caution clients that doing anything takes a while. You've got to expect that you'd have 6 to 9 months of back and forth before anything tangible came into place. But the simple answer is yes, the president has wide authority on his tariff powers to implement tariffs that would accomplish this goal in practice. Of course, you can't do this where you have a singular pushback on the tariff side. You would have to create a broader framing and broadest lattice work, but all of that can be done. And so we have to take seriously these threats under his 301 power in particular, where he can do many of the things that he's implemented, even though it's going to take a little bit of time from when and if he actually gets behind the Resolute desk again.
John, wasn't it Lori Calvasino who said that basically it's like staring at the sun?
Yeah.
That essentially, you've mentioned this before, that this election cycle is like staring at the sun. It's obviously massive, it has significant implications, and it's blinding in your ability to actually respond to it. How seriously are your clients, Isaac, taking concepts like this, the idea of a 100% tariff that's being thrown out there by someone who could potentially get the power to do that?
It's a little bit concerning. I got to tell you, there is still some disbelief that it's going to be Biden v. Trump to begin with among my clients. And then there is a almost outright dismissal of the tariff side. I think that a vast majority of clients are focusing on what Trump would mean from a deregulatory perspective for energy, for financial services, for healthcare. And they are just pushing aside the risk of the tariffs. And I think this is in part because of what we saw last time. If you recall, the first 2 years of the Trump administration was focused on tax cuts. It was all of the good for the market, right? And then we began focusing on tariffs. This time will be different. Tariffs will be a day one focus. And that's something that I'm trying to push across in terms of understanding what will happen if Trump is, in fact, the winner of this election. I think the market's got to start to come to terms with what that means, not just for geopolitically, but for supply chains and for the Federal Reserve.
Isaac, one thing that Ken Rogoff of Harvard said in a recent interview on Bloomberg TV was that both Trump and Biden were incredibly protectionist presidents, some of the most ever. Has that been accurately priced into markets, putting aside who wins, the fact that both of them are likely to have pretty protectionist policies?
So I think the simple answer to that is I don't think the market is prepared for each one of these candidates to try to out-China hawk the other, right? Again, we have 230 plus days of this to go, and we're going to have a fair amount of China bashing in particular. And so I don't think that the market's prepared for that. I don't think that the market is prepared for what's incredibly important here, which is former President Trump going after the onshoring and nearshoring even themes that we've seen over the past few years. So it's not just China bashing. He's going after Mexico. This could also lead to cooler relations with Taiwan, cooler relations with Canada. There are myriad implications there that I think the market's looking past, in part because they're not sure that it's still going to be Biden v. Trump. And then they think that Trump is just talking on the campaign trail to get votes and would immediately dismiss these policy goals when he's in the White House because of their inflationary and economic impact. I'm not sold on that.
So well said. Isaac, wonderful to catch up with you, sir. Isaac Boltanski there of BTIG, content and sequencing. If you go back to the first term of the former president, the sequencing, and Isaac was talking about this, and we've covered this before, the focus was on tax cuts. Then later on in the term, the back half, the focus was on the trade war. To Isaac's point, the focus this time around is going to be on tariffs almost from day one, based on how the campaign is going.
And he's saying it's not being priced in or taken seriously at all because people are saying it's just campaign rhetoric. And are these even going to be the candidates that we have? Because people are still doubting that.
And that's still where the conversation is. Just struggling to move on from that. These are the candidates that we have in front of us right now.
Yes.
Coming up next, Claudia Sahm of Sahm Consulting on the Federal Reserve. The brilliant Claudia, just around the corner.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. leagues have sort of toyed around with. Should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is quite a start to the trading week. Equities all-time highs, possibly again. We're positive by 0.8% on the S&P 500. The Nasdaq 100 up by 1.2%, taking back some of the losses of the last couple of weeks. And I have to say we can do that in a single session because we were only down by 0.1% last week and something like 0.25% Lisa the week before.
That's what I was going to say. Is this a dip that's viable? I mean, does that even count as a dip? We're down less than 1% over 2 weeks. It's the biggest weekly fall of the year, and still this is something that's viable because why not?
Rallying again. Equities up, up and away in the face of a real repricing in the bond market. 2-year back in the 470s, further out along the curve, a 10-year back in the 430s. Both of those maturities, those yields higher last week by more than 20 basis points. Lisa, off the back of hotter than expected CPI data, backed up by an upside surprise on PPI.
What I find interesting is that nobody's talking about retail sales, and to the extent that they are, they're talking about them as not being that bad. That's what we heard from Lindsay Piegza. And at the same time, when do we start seeing this narrative shift on the margins away from yields are just rising for the right reasons, which is growth? At what point does it become yields are rising because inflation is still too sticky, even as growth decelerates? Somehow that part of the narrative has gotten thrown out.
If you were worried about a really big reacceleration of a super hot economy, retail sales didn't speak to that, did they? 2 months of it, not just a single month, but 2.
Which is, and you're not just seeing it in that retail sales number, but also in some of the credit card data that you're seeing anecdotally out of some of the banks. It's not conclusive. This has been a very maddening cycle for anyone who wants definitive trades or definitive convictions, because this isn't a time you're going to get them, right? I mean, that's essentially where we are. The Fed's probably going to reflect that on Wednesday.
Can you find it in foreign exchange? Dollar yen, 149.
Oh, yeah. Wow.
Dollar yen. What did Kit Juice's stock trend say? Someone tell the Japanese yen that it's a historic meeting tomorrow. 149 on dollar yen. We've basically seen yen weakness, some mild yen weakness over the last 5 sessions. So that's the longest streak of the year so far. Still basically in and around 150, at least going into potentially the first interest rate hike in 17 years.
Yeah, you can feel Kit Juice's frustration and the frustration of all FX strategists basically saying, wake up, do something. This is going to be a massive move, and yet nothing. Look, all of these moves are coming after great expectations for so long that people have baked it in. I'm struck by how much that we're seeing stasis in the euro versus the dollar. These are going to be long-term shifts, but right now, is anything changing relative to expectations at all?
Right now, in FX at least, not much. 149 on dollar yen. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu firing back at Senator Chuck Schumer.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
Netanyahu's comments coming after Schumer called for elections to remove the current Israeli government. Schumer labeling Netanyahu a, quote, obstacle to peace as concern grows about the civilian toll of Israel's war on Hamas in Gaza. Netanyahu saying that another ground offensive in Rafah is the only way to eliminate remaining Hamas brigades. That, as we know, at least we've framed this a few times, is a red line for the President of the United States. What remains unclear as to what happens if indeed Netanyahu is how bent on crossing it.
And what's also unclear is how much of some of this rhetoric really is coming as a plea to certain constituents in the Democratic Party to say, we know, we're on it, we want to ratchet this back, we want to distance ourselves from this conflict to some degree. To me, that's going to be one of the hardest parts over the next couple of weeks. How much do you distance policy from politics when it comes to some of the rhetoric coming out, frankly, from Schumer, from Biden, and then what we were just hearing with Biden with respect to the former President Trump and what he had to say about tariffs?
Because the rhetoric has shifted big time, that's for sure. Let's turn to our next story. Apple and Alphabet considering a deal that would allow Google's Gemini AI to power new iPhone features. Sources telling Bloomberg the tech giants are actively negotiating a plan to let Apple license Gemini AI models for new iOS capabilities as soon as this year. The deal would build on Apple and Google's years-long partnership over Safari's default search engine. It would also give Gemini AI billions of potential users. But the potentially blockbuster AI deal also threatens to draw more antitrust scrutiny. So we started the program with this story, Lisa, and we talked about the three dimensions to this. One is antitrust, clearly. Two is how much Apple is apparently behind in this effort, given that they need a partnership with Google to do something about going forward from here. And three, the potential, and this is the Dan Ives of Wedbush dream, that you adopt some of this technology, these advancements, as early as September, put it in a new phone. And for those of us, me, others, who have been sitting on the sidelines waiting for a new smartphone that's actually worth upgrading to, this could be the year.
So just to pick apart some of those things, the middle one in particular, that they're late, that they're not as far along as people previously thought. They just shifted their staff that had been devoted to the Apple Car to the AI initiative. Is there a race to get to that September finish line in tandem with Samsung? We know Samsung will probably unveil something around that same time with artificial intelligence, using technology from Qualcomm and a bunch of others. Is there some sort of imperative to have that kind of timeline and not have the Apple luxury of waiting and then just doing it better? To me, that's the signal here that's really significant.
Yeah, but what's the risk that others go to Samsung, or that we just don't upgrade at all if they don't do that?
You know,
both?
I would argue both, because if there really is transformative technology that somehow makes it a different experience, then why wouldn't people go to the Samsung, right? Why wouldn't they gain market share in a way that Apple kind of can't afford to at a time where the iPhone still is the bread and butter of the entire organization?
Because the ecosystem's so sticky and you can't get away from it. It would be such a pain. Can you imagine the pain of switching at this point to something else?
I have family members who are very against the sort of forced ecosystem that you have to participate in, and so then they bow out and they go to Samsung, and then all of their texts are so annoying because you can't sort of like them, and when they like them, then you get a separate message. It's so irritating.
The regulator feels the same way. All eyes on this week's Fed rate decision. The FOMC widely expected to hold rates steady Wednesday and make their first cut potentially in June. Investors will be focusing on the so-called dot plot and an updated summary of economic projections. Fed Chair Jay Powell telling Congress earlier this month that the central bank is, quote, not far from an initial cut as it looks for just a bit more evidence inflation is moving towards 2%. Former Fed economist Claudia Salmon, good friend of this program over the years, joins us now for more. Claudia, wonderful to catch up with you. As you've said, maybe a challenge for Chairman Powell this week is to make sure that everyone stays around the 3 implied in the median dot. Can we just start with the dots themselves? Because I know you have thoughts on this. When can we and how can we get away from this?
It's hopeless at this point. I mean, everyone wants some scrap of certainty, and they look at the Fed and have a very misguided belief that the Fed is going to give that to us. The Fed would really like a scrap of certainty about what they're going to do later this year. My hope for this meeting, it is the most boring meeting ever, and you have traders falling asleep at their desk. Like, we know they're not going to cut this week, and we better not see anything material change on that summary of economic projections. In particular, are we looking at likely 3 cuts or 2 cuts? Jay is absolutely, my reading of what he has said, he is a let's cut in June. He's got to keep it together. If those dots move towards July, which I actually think that's not likely, or the longer run estimate of where the rate should be, the infamous R star, either of those two could get people antsy and push the expectations to July in the markets.
I am a long-standing hater of the dot plot. I love the way you write. Thank you for that. Claudia, I am curious whether you think it's a liability, though, that the Federal Reserve isn't operating with some sort of overarching thesis of where the economy is right now post-pandemic, about whether it is sort of a hotter and higher inflation regime, or if it is going to revert back to something more of what we were accustomed to pre-pandemic.
my expectations of what the Fed is on track to do did not change last week. We had the second disappointing read on inflation. We also had the second disappointing read on retail sales. And Powell has talked about multiple times that the risks to the two sides of the mandate, the stable prices, the maximum employment, those risks are coming into balance. And we saw that last week, right? That nailed the balance of, yeah, inflation has been not so good. And really January, clearly from the February, looks pretty fluky with owner's equivalent rent coming back down. And those retail sales, those are not good numbers. I mean, I did consumer spending at the Fed. Those are not good numbers. So that should maintain the quote unquote coming into balance.
Well, can you elaborate a little bit on why those are not good numbers and why that's important? Because we were hearing earlier this morning from Lindsay Piegza that they weren't that bad and that you're seeing a deceleration, but overall, there still is quite a bit of spending and you can tell that balance sheets aren't terrible. Why are they terrible?
So in terms of the retail sales, I mean, these were declines, right? Like these aren't good numbers. And yes, a deceleration was what we were looking for, but we know, and the flip side is the acceleration worries on inflation. We know once things get going, it's kind of like the snowball, right? This is a big economy. It takes some work to get it going. And then you can end up with like a really big snowball that's like crushing us and bringing down the economy. So once you start going in a direction, there is a danger that you build up speed in that direction. For the economy, for the spending side, that would be a contraction in spending. That's a recession if we get there. And on the inflation side, if that not just sticks, but kind of gets, going, that's a big problem too, right? So they have the potential for two big problems, which speaks to don't do anything, just let us see.
Claudia, I'd love your thoughts just to wrap things up on inflation as well. We had a hot CPI print relative to expectations, likewise on PPI. Were there components of that that gave you encouragement, maybe even made you uncomfortable about the path ahead? What were you focused on?
Well, first, the encouragement. We did see the owner's equivalent rent, which had come in really hot and inexplicable in January. That did cool back off. So that tells us a lot that piece, which was very important in CPI and important in PCE, that was something fluky in all likelihood. Now, the discouraging part is what we've gotten into in the core services outside of shelter, the super core. The stickiest part in there is motor vehicle insurance. And the homeowner's insurance is in there too. That is not about the Fed. The motor vehicle, that is a knock-on effect of the used car prices. The car prices were high. They're making up for repair costs. There's really not relief on the horizon for that piece until later in the year. That's an unfortunate part of inflation for us to latch onto the Fed to wait on. And yet it's in there. I mean, it is making a contribution. It is outsized from before the pandemic, and it ain't going away probably for a little while.
You know the inner workings of the Federal Reserve better than most, Claudia. How do you think they would deal with that around the table this week? And how do you think Chairman Powell will address the topic in the news conference?
My goal in the news conference to get markets to kind of stay where they are. And we're at this rare moment that the Fed is kind of lined up with markets, this June cut and probably where Jay Powell is. So I think it's reinforcing you have a balance of risk. If we don't see retail sales mentioned in the statement, then that's a sign they have gotten more hawkish. There are all these details under the hood, like motor vehicle insurance. Yeah, that's wonky. And yet it gives hawks, I mean, if you look at the top line, it gives them cover to push out to July. Frankly, I think they're going to win. July is my baseline. And so it's the messaging, but the Fed knows better. Like they know what's under the hood. It's just a question of, can they look past it, or are they going to get antsy like sometimes they do?
Interesting. Claudia, you're one of the very best, and we always appreciate your time. Thanks for being with us. Claudia Sam there of Sam Consulting on the Federal Reserve. The inner workings of the Fed, how they look at that data, Lisa, from last week, because it's not how you and I want them to look at it. It's how they actually look at it that matters.
And it actually matters, all the line items and exactly what the comps are actually showing and how much this is sticky inflation or not. I sense frustration from everybody this morning. I feel like it's a very frustrated morning. Is it just me?
Is it still Q1?
Yeah, well, it's just sort of...
How long does the first quarter feel at this point?
Exactly. I mean,
right?
It's sort of, I get the sense people want some certainty. They're not getting it, and they're really frustrated.
I was thinking this yesterday evening. I was getting together everything for this program, going through the notes, looking at markets. I was just thinking, I can't believe it's still Q1.
I know, it's been ridiculous.
Seriously.
Yeah, I think a lot of
people... It feels like we're sort of like deep into the second quarter already. I mean, to your point on the election, It's 8 months away. It's 8 months away.
Right. So how are we going to actually evolve this, considering it's going to be literally the same story, which is, yes, they are still the candidates. Yes, they are running. And we're going to have to figure out what that means.
Andrew Hoddenhorst, Citi, just published, so I'll share some of that with you if you'd like. If you don't, I can't hear you. So despite stronger core inflation, I hope you'd like this. We do not expect a significantly hawkish FOMC meeting on Wednesday. In our base case, median dots stay put, indicating 75 basis points of cuts this year. But even if we're wrong, and the 24 median dot shifts to imply just 50 basis points, Powell is likely to dovishly emphasize that the Fed is on track to cut rates this year due to sub 3% year-on-year core PCE inflation, even if activity holds up. So that's the view. There is just a view that even though the data's changed somewhat, that Chairman Powell hasn't.
They want to cut, and that's the reason why I think a lot of people have enthusiasm around equities, because if the bottom line is they want to move, and as Claudia Sam said, maybe they get antsy and they do something even if the data doesn't really back it up.
That decision coming up on Wednesday. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The NASDAQ stock market says it has resolved connectivity issues this morning. Pre-market trading on the exchange was disrupted for more than 2 hours. In a statement, NASDAQ says it determined the root cause, but it didn't go into further detail. Bloomberg data shows no trades printed on the NASDAQ global market starting at 4:09 a.m. New York time. The exchange says that any unacknowledged orders on its Rash Fix system have been canceled and put back to customers. Barclays is looking to expand relationships with sovereign wealth funds and private equity. Barclays CEO C.S. Venkatakrishnan offered more detail earlier in the program this morning.
I think it's an important part of the shift that's happening. And it's happening because previously in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
Last month, Barclays announced a $2.5 billion cost-cutting drive and a reorg to boost profits. The March Madness games are set. Millions of fans are now going to try their hand at correctly predicting 67 college basketball games for the elusive perfect bracket. Good luck if so. Defending champions UConn are one of the year's top seeds alongside Purdue, Houston, and North Carolina. No fan has ever completed a perfect March Madness bracket. The NCAA says the odds of doing so equate to about 1 in 9 quintillion. That's your Bloomberg Brief. John.
We will do what we always do on this program. Manager is a Purdue grad. Boiler up.
Yeah,
every single year.
Yeah, is that what you do?
Yeah, every year.
Yay. Let's take it like
trying to make that mid-year reval go just a little bit better.
Is that so?
Yeah.
Is that what's going to do it?
Boiler up. Up next, all eyes on NVIDIA.
When you look at the godfather of AI, Jensen, NVIDIA, and we'll see it on Monday, right now it's their world, everyone else is paying rent. The Flex the Muscles event for Jensen, wearing his black leather jacket.
I love how Dan talks about this. It's like a wizard putting on a cloak.
Leather
jacket goes on.
Yeah.
Talk up the stock another $200 billion.
The godfather of all AI.
Just like that. That conversation up next. This is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Live from New York City, Fed decision just around the corner. That takes place on Wednesday. Two-day meeting starts tomorrow following a BOJ decision, which may include the first interest rate hike since 2007. Bramo, drumming things up.
Oh, yeah, it's going to be so exciting.
It's just not happening, is it?
Check out that currency pair.
I mean,
wow.
I say it's not happening. I'm not saying the interest rate hike's not happening. I'm just saying, like, the price action's not happening going into it. Dollar yen is almost totally unchanged at 149. Elsewhere, we have some price action if we can turn towards the board. Equity futures are up by 0.75%. Spoil over here. That's a nice rally. Takes back some of the losses of last week and some. Yields are higher again by 2 basis points. We're staring down the barrel of the highest yields of the year so far. Very close, Lisa, 432.42.
Which comes because we are seeing hotter than expected inflation, and the big surprise of the year has been the resilience, both with respect to the economy as well as earnings. You put both of those together, it raises this question, how are rates going to go down all that much in the near term?
Yeah, this week is not just about central bank decisions, it is also about this. Under surveillance this morning, all eyes on NVIDIA.
When you look at the godfather of AI, Jensen and NVIDIA, and we'll see it on Monday, right now it's their world, everyone else is paying rent. This is a grand entrance, and it's also a showcase. It's to flex the muscles. Look, we believe it's a 1995 moment. This AI revolution.
Here's the latest. NVIDIA's annual AI conference kicking off with sky-high expectations. Analysts and investors calling it AI Woodstock as they wait for new product announcements and more that could solidify NVIDIA's leading position among AI players. Meanwhile, Apple is playing catch-up. Sources telling Bloomberg that Apple is in talks to build Google's Gemini AI engine into the iPhone. Bloomberg's Alex Webb joins us now for more. So, Alex, two separate stories. Let's start with the NVIDIA conference, and then we can turn to Apple. What are you expecting from Jensen a little bit later today?
We're expecting to see what the next generation of chips looks like and what they can do. The B100, which people know is coming, but the nature of the innovations in it will essentially determine how optimistic the investors are about it meeting these incredibly ambitious targets that analysts are setting for it. It is clearly trading at a hefty old premium, but hefty old numbers. It's 35 times its forward earnings at the moment. That's not massively out of kilter with names like Microsoft. It still trades actually at a bit of a discount to AMD. That's partly because AMD's earnings haven't yet been, the estimates haven't gone up to meet the expectations where the stock is at. So the thing will be fascinating to see how similar this thing is to, say, an Apple event. I mean from a trading perspective, because quite often what you see with an Apple event is a bit of profit-taking. The adage is you buy the rumor and you sell the news. Well, there's been a little bit of a sell-off in NVIDIA over the past few days. Sometimes good news actually doesn't deliver the pop in the shares that you might expect because people think, oh, well, actually, it may not get much better than this right now, and so you see a bit of a sell-off. So it'll be fascinating on many different levels.
That's a strong point. So, Alex, let's talk about an Apple event. The reporting from the team here at Bloomberg, fantastic reporting that Apple is in talks to build Google's Gemini AI engine into the iPhone. We had some commentary from our good friend Dan Ives at Wedbush this morning, calling it a major win for Google to get into the Apple ecosystem. Alex, I want to understand from your perspective, in your opinion, what this says about Apple and where they are in this race.
So it's interesting because I floated this idea to someone just, as a possible column idea. Maybe we should write that Apple should actually open up Siri to one of these other AI engines, and the response I got from a colleague was like, Apple would never do that. And of course, this looks to be what they're doing. And it shows actually two things. Firstly, of course, that Apple perhaps isn't as close to having its own competitor to Gemini, to GPT-4 as it would like, but also how significant, how important it sees this as a competitive differentiator. If you're going to have phones over the next 1, 2, 3 years where you can properly engage with an AI engine conversationally, that might be a significant differentiator when it comes to people deciding what handset they're going to buy. So Apple, clearly is a defensive move to ensure that they have this tech in their devices, and they are handing over what could be a very significant part of that proposition to what is, frankly, in mobile operating systems, a meaningful competitor in the form of Google.
Alex, how can I get around the idea that a lot of regulators are not going to like the fact that two of the biggest companies in the world are teaming up to be even bigger?
Well, the thing is, it's slightly different from the search thing, right? Because, of course, what was happening with search is it was pushing people into Google's ecosystem and therefore giving Google the opportunity to serve ads on that basis. We don't fully know, actually, how this is going to push people towards a similar thing. The way that AI is being monetized is still kind of being worked out. It's very much a cloud product at the moment. The people providing these systems are making money from selling the cloud services. So it's a slightly different case from Google being the default search engine in iOS. Doesn't mean, of course, that the regulators won't look at it, but it isn't, you'll excuse the pun, apples for apples.
Alex, I want to finish on Google because they've had a difficult time, and I did get the pun. We'll let that go. I want to talk about Gemini. Alex, it hasn't been a good start for Google unveiling and rolling this out. And I guess my question would be, I get that Apple's behind, but is this something they want to go near at this point?
I think, look, the concerns with Gemini were very much about this image generation piece, and that was the colossal flub, which, of course, they've admitted to and said that they need to fix. They recognized that it was a mistake. At this stage, it looks like, and we don't fully know, and don't forget this deal with Google is not signed. Mark Gurman, our colleague, also reported there were talks with OpenAI. But it seems more to be on the language front, right? To be able to engage with it, ask questions, perhaps, search the web as well. The image piece is entirely separate. There's also a little bit of time until this will come into a product. If they reveal such a deal at WWDC, which would be in June, it wouldn't actually hit the operating system until September time, most likely.
Yeah.
That gives Google plenty of time to fix these problems.
Alex, thank you, sir. Alex Webb there of Bloomberg, looking ahead to the NVIDIA Developers Conference a little bit later today and talking about that potential partnership between Apple and Alphabet. Alphabet in the pre-market, celebrating that win, if that is one, up by something like 5%. Here's a win for us. Surveillance on tour tomorrow. Fantastic lineup. We'll be taking the show live to the Bank of America trading floor. Here's the lineup for you. The CEO, Brian Moynihan, Mark Cabana, the head of US rate strategy. We'll catch up with Savita Subramaniam, the head of US equity strategy, Mike Gapin, the head of economics, and a whole lot more across 3 hours of programming, Bramo, starting 6 Eastern tomorrow morning.
I'm so looking forward to it, especially given the fact that we are heading into such a massive week, and to get sort of a bird's eye view on the different components of an economy very much in flux will be terrific.
That'll get the week started in a big fashion, going into those big central bank decisions later on this week. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in. I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Equity markets this morning managed to claw back some of the losses in the latter part of last week. Alphabet is bid on that beautiful new relationship of growth between Apple and Alphabet. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up on the show, investors brace for a busy week of global rate decisions. AI in focus with NVIDIA's developer conference getting underway. And Apple turning to Google in its search for AI solutions. We begin with the big issue, pointing down to the Fed.
When I look at the growth of the economy, I look at the labor market still being relatively healthy, and I look at the inflation not getting to the terminal rate of 2%. I don't see the cut motivation. I think that's the problem that I'm wrestling with is what is the Fed policy cover, if you will, to be cutting rates when what they're doing seems to be working and yet not quite to mission accomplished.
Well, Bloomberg's Mike McKee joins us now to set the table for the week. Mike, good to see you. It's all about the dots or not.
It is all about the dots, Manus. The Fed has pretty much signaled they're not going to do anything with interest rates. So what else do we get? Dot plots and the summary of economic projections. The dot plot is the one to watch. That's where Wall Street's eyes will be. If you take a look there at the red line, that is the OIS, the overnight index swaps view of where rates should be. And as you can see, it's just a little bit below the median dots in 2024. So there is a feeling that maybe we'll see some movement away from 3 cuts to just 2. It would take 2 members to move their dots, but at this point, we don't know. But if there is a change, it'll show up there. Don't worry about 225, 226, because those are so far out. There's so much going on that any change there would be essentially meaningless. But the 2024 dots are going to get a lot of attention. Also, the summary of economic projections, because that, in theory, underpins the dot plot. As you can see, the Fed's December numbers are a little bit behind what economists surveyed by Bloomberg last week came up with, especially for inflation. So will the Fed move their inflation targets higher as a justification for changing their dots? Do they see a stronger economy? Remember, Raphael Bostic said that is a risk out there for the economy. So those are the 2 things we're going to be watching on Wednesday. Also, Jay Powell obviously has his news conference.
He has indeed. I wonder which is going to be more important, Jay Powell's news conference or Jensen Huang's conference later today on AI. Listen, talk to me about what the future might look like in a changed political landscape. We've got the Wall Street Journal reporting that Donald Trump has been presented with 3 names as the possible replacements for Jay Powell if he becomes president and if there was an interruption in Powell's term. or maybe even after?
Well, it looks like this is somebody running something up a flagpole and seeing if Donald Trump is interested in saluting. It was a group of 3 names, you know them all: Kevin Warsh, Kevin Hassett, and Arthur Laffer of the Laffer curve fame. They were put together by people who are not officially part of any kind of transition team. It's just a group of people that Stephen Moore and Art Laffer, funny how that works, are promoting. Warsh was a member of the Fed, and so he could be a serious candidate. Hassett was chairman of the Council of Economic Advisors. Laffer's interesting, especially since he's putting his own name forward. He would be 85 at the time that there is an opening on the Fed, and he is against tariffs. So I'm not sure that one totally fits with Donald Trump, but I wouldn't pay a whole lot of attention to this. The current chairman's term runs until January of 2026. So it's going to be quite some time before anybody is going to be named to replace him one way or the other.
Okay, Mike, interesting kite flying by the journal. Mike McKee there on the week ahead. Let's start the conversation with BlackRock's Amanda Lynham and Toll Balkan's Michael Purvis joining me here in the studio. Michael, to you first of all. It's been a while since we've had a human in the studio, so welcome. Good to see you, Amanda. Good to see you as well. The acknowledgement could be that the disinflation narrative is slowing down, and therefore there is merit in cutting the dots, the median dots from 3 to 2. It wouldn't take much to do it. Do you think that that would be good, prudent governance to shove the market down to 50 basis points?
Look, I think it's an irony that crude bottomed in this, over the last 6 months. It bottomed on the same day that the Fed's December FOMC occurred, when they really delivered that dovish surprise here. And since that dovish surprise, we've seen a wide range of inflation data come in hotter than expected. We've seen a wide range of economic data, exhibit continued persistence and be hotter than expected here. So I think what the Fed seems to be signaling from December is that it was a pivot from hiking to something that's either static or cuts if warranted. And so what warrants the cuts? I think it's going to be, I don't think Powell's going to shoot until he sees the white of real disinflation eyes here. And the reality is we've seen so many facets of inflation, the reported inflation that we got last week, continuing to trend away from the Fed's 2% target. If you look at the monthly sequential prints across a wide range of the subcomponents there. So I think the Fed's going to signal on Wednesday, we'll cut when warranted, but right now it's not warranted.
So they want to see the whites of the eyes of the disinflation returning again. Amanda, good morning. Good to have you with me. Kicking off a big central bank week, but let's focus in on the Fed first of all. This disinflation narrative has been interrupted, or the trajectory of it. We expect the estimates for core and headline inflation to be raised again. Are you positioning for a jolt in terms of this market? We can debate where rates get to, but the rates market has backed up considerably. Would a 3 to 2 shift in the dots be a material shock to risk and to this market this week, or is it already imbued?
Good morning, Manus. Thank you for having me. I think as it relates to the dots and the summary of economic projections, I think stability would be good for market sentiment. So I think downgrading that to only 2 cuts versus the current 3, I think would send a bit of a shock to the market. It feels to me, based on our conversations, that that's on folks' radar as a risk, but not necessarily the base case. I think from our perspective, there were 3 really important things heading into this meeting on Wednesday. One is an acknowledgement that we are at peak rates, so ideally that there's a very low likelihood of additional hikes. The second would be that rate cuts are coming eventually in 2024. Our base case remains the second half of 2024, with risk skewed earlier within that second half range. That's a wide range. I think it's hard to have any precision beyond that. But just the fact that rates would eventually be coming in 2024 is, I think, what the market is going to listen for. We can debate about where the terminal rate is later. And then third is really important that the reason for any future rate cuts or the rate cuts that the market is expecting is really driven by improved inflation eventually, as opposed to a downturn in growth. If we have those three things, we think that's a pretty supportive backdrop for risk assets. And I think the direction and the path of least resistance in my market, at least for corporate credit spreads, would be tighter on that, especially as the headwind from corporate credit supply is waning as we head into the blackout period around earnings.
Okay, and we'll come back to those spreads because they are mighty tight, and you've identified that in IG and in high yield. 92 basis points on IG, but we'll come back to that in a moment. Michael, I want to pick up, I mean, Amanda is giving herself, and I think the market perspective, the breadth that we need in terms of the Fed needs more concrete confidence to actually start this cycle, because once they pull the trigger, the market is then going to expect a cycle to ensue. You would say a barrier to that cycle starting is super core, and you identify this and you talk about, and this is where I want to talk about the possibility of stagflation. Now, this is what you identify as being the super core. We're on a trajectory now. It's the highest since June 2022, and this is looking at it over a period of time. Does this cause you hesitation? Should this cause the bond market more hesitation than it is currently showing?
Look, I've been on this page for, well, actually, I think I originally presented 18 months ago that when the Fed got to its terminal, that it should camp out there for a very long period of time because of some structural inflationary forces that are creeping through at a slow and kind of somewhat convoluted pace, but they're persisting, and that a lot of it comes down to various supply, whether you can talk about labor, you could talk about shelter, and also even commodities, as we're starting to see. There's a big supply dimension to all those things that really doesn't have anything to do with COVID, but they are slower moving forces there. So my view here, look, I've been officially at the 1 to 2 cuts this year, but I think there's a real scenario of 0 cuts that seems to be an increasing scenario, a chance of a scenario here.
So briefly, if it was zero, if it did skew to 2 and then to 0 cuts, a real probability, what would that do to the rates market?
Well, I think investors have to be prepared for a 10-year. They have to be able to visualize how do risk assets trade with a 4.5% 10-year, then maybe a 5% 10-year. Right now, obviously, last October, things got a little, you saw the VIX spike and all that with that move here. I would suspect that you're going, if rates do continue to drift higher, it's not going to be nearly as violent. You did see the MOVE index, the VIX for the Treasury curve, come down to sort of cycle lows on last week, even with a rate move higher here. There, and I think that's largely because this is more about what I would call tweaking. I think we're in a tweaking cycle from the Fed as they're adjusting it, as opposed to the violent inflation that we had in 22, which unleashed a violent hiking cycle.
Yeah, and I think we are that. Amanda, we're getting these moments of irritation, but I want to revert back to where you said, you talked about investment grade and high yield, those spreads being tight. If there's a risk, as Michael says, and it's not a 0 risk of no rate cuts, maybe 2 rate cuts indicated, maybe even shaving that down, would that shake risk in your markets by any magnitude? And I'm talking about IG and high yield. That's what we're showing at the moment on the screen.
Yeah, sure. It depends on the reason, and I think Michael's exactly right. The velocity of getting to that kind of higher rate level is important, but under the surface, to answer your question, Manus, if we're going to two cuts priced or no cuts priced in 2024 because growth is so resilient, credit would like that outcome, so long as that velocity in getting to that higher rate move is not extreme. But if it is because of persistent inflation and a resurgence of stagflation concerns, that is typically not a backdrop that corporate credit likes. To the point on spreads, they do look optically tight, but I think it's important to note that we're actually still wide to the mid-2021 levels. So there is some scope for further tightening, again, so long as that growth backdrop remains supportive. I think the key outcome for allocation tactically, from an asset allocation perspective, is we're seeing more interest in clients kind of putting on floating rate exposures. That could be in liquid credit, in private credit, and so giving some additional additional diversification to the portfolio if these rate cuts do get priced out to a further extent, I think is probably a smart move tactically, and that's something that we are having come up in more and more in our conversations.
All hail the RFNs. Amanda, stay with us. Amanda Lyon and Michael Purvis, my guests this morning, setting the tone on a big week for central banks around the world. Let's take a look at the stocks ahead of the opening bell. Abigail Doolittle is with me side by side.
Manus, we do have U.S. equity futures very firm, and this has a lot to do with the Mag 7, starting off with the shares of Alphabet. They are headed to the best day of the year if the gains hold. This as Apple is holding talks with Alphabet to let Google's Gemini power its iPhone features. This could be a blockbuster agreement and shake up the AI industry, some are saying. NVIDIA up 2.7%. Their AI event kicks off in San Jose today. It's been dubbed the Woodstock AI by Bank of America analysts. More than 300,000 people are expected to attend. And then Tesla up 4.1%, popping on reports they may raise prices instead of lowering them. That's been the report over quite some time now, but on the Model Y this April, Manus.
There you go, Woodstock of AI, who'd have thought it? Abigail, thank you very much. Context for that developers conference later on this afternoon. Coming up on the show, the BOJ kicks off a busy week of rate decisions.
The Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost going to happen.
From the BOJ to the Bank of England, the Fed isn't the only game in town. That conversation next on Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg.
The Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost going to happen. Having said that, if they move, we'd expect them to move, but also at the same time talk expectations down, so they don't want to have a runaway policy expectations of higher and higher rates. They'd want to push back against that.
A monumental moment for Japan. Is the central bank widely expected to hike rates for the first time in 17 years? The BOJ is part of a busy week of central bankers globally. Monetary decisions will be made in nearly half of the world, including the 6 out of the top 10 most traded currencies. Rev up your FX vault. Enda Curran is with me now. Top of that agenda is going to be Bank of Japan. Enda, good day to you. Set the table for me. Good morning.
Well, there are over 20 central banks decisions this week, Manus, and like you say, the BOJ meeting will probably be the most closely watched BOJ decision in years, if not longer. We had, of course, the all-important union wage round results that came out at the end of last week, showing that wage gains are probably going to be much higher than expected. A lot of economists saying that's the final green light now for the Bank of Japan to go ahead and pull out of that negative rate territory. The question becomes then, does it push further into positive territory? Does it tweak its other policy tools? Now, there is still a camp out there that's saying perhaps the BOJ might wait until April, but by all accounts, one of the last remaining hurdles for that hike has now been cleared. Beyond Japan, also it's worth noting that Australia is meeting this week. Inflation slowing there, so clearing the way perhaps for the central bank to suggest they can move towards a rate cut at some point this year. Bank of England also meeting. No major change in their outlook or signal expected there. They will have inflation data before they meet, but a bigger change is expected to become in May. But net this week is expected to show that all of these central banks are moving at an asynchronous pace. They're all dealing with idiosyncratic issues impacting their own economies in different ways to everyone else.
Indeed, and everybody with one eye on the Fed and what their messaging is going to be, because that gives them all a certain amount of guidance. And thank you very much, Enda Karen, with the very latest on what's going to be a big week for global central banks. My guests this morning are Amanda Line and Michael Purvis. Amanda, to you first of all, I look at this as a historical moment. To me, the Bank of Japan moving, yet yen is not reacting in the typical way that we would expect it to do, scrapping of negative rates, etc. Quantify that for me in terms of the flow dynamics for fixed income here in the US as a result of a global event.
Sure. So roughly 1/4 of the U.S. corporate credit market is owned by foreign investors. You can see that clearly in the Federal Reserve flow of funds data. So foreign participation in U.S. dollar credit is meaningful, and for much of the post-financial crisis period in particular, Japanese investors have been net buyers of credit alongside foreign investors more broadly. The normalization and I would say the beginning of what might be a hiking cycle from the Bank of Japan has caused investors to ask whether that participation appetite for U.S. dollar corporate credit could shift. We think that's really a high bar and a longer-term issue, even though it is symbolic, as you mentioned, Manus, the fact that we would be moving out of negative rates in Japan. The tweaks are expected to be minor, and the differential between the policy rates and the rates in Japan is still pretty wide. That being said, it's something to watch, and certainly we will be doing that. The other thing I would add is that when you think about foreign participation in U.S. dollar credit, it's not only driven by economic factors on paper like hedging costs and yield differentials. It's also driven by sometimes a lack of alternatives in these domestic markets. And so, as you well know, the U.S. corporate credit market has significant depth and breadth. And in a lot of instances, including in the case of Japan, there just isn't a robust corporate credit market for those investors to participate in. So they often look to the U.S. dollar market. That is a structural shift, and that we don't expect to change on the back of any monetary policy shifts.
Thank goodness for some markets, TINA still exists, even when it comes to the credit markets. Amanda, stay there. Michael, I mean, maybe it'll mean more for the foreign exchange market than it will for credit markets. Is that, I mean, so far it hasn't had the reaction function that we would have presumed. So talk me through why.
Well, I think I agree with you. I think it is a historic event, what's going to be happening with
if it happens.
If it happens.
If it happens, I should count it.
But what's important for the U.S. markets, I would suggest, Maddie, is that one of the questions hanging over the Fed is, are we normalizing to pre-COVID, meaning 2017, 18, 19, or are we maybe normalizing, as I think we are, to something before the great financial crisis, before the QE era? And with the Bank of Japan really sort of being the last to really get out of negative interest rates, I think it's a gesture that the collective mindset of these big central banks is going to be away from this ultra-dovish policy and to normalize to something that we didn't know that was very customary before the financial crisis. That's very significant. And I think one thing to watch is just the 10-year term premium on the U.S. Treasuries, whether that really helps lift it up into positive territory on a sustained basis. And I think there's a good chance it will.
For you, Amanda, obviously term premium is going to be important, but I want to just close off with a snapshot on flow. We've had a heck of a start to the year here in the United States of America on the corporate front. Does that issuance continue unabated?
I think we'll get a temporary reprieve around earnings, as we typically do when corporates enter their quarter-end blackouts. You're right, the fund flow dynamics into corporate credit have been exceptionally strong to start the year. I would say that even understates demand a bit because that doesn't capture the entire universe of buyers. We talked initially, what would spreads do if rates backed up a bit? Yeah. There's a large cohort of yield-based buyers that would actually welcome deploying capital at even higher all-in yields. Again, presuming that backup in yields wasn't disorderly. So I think that the demand should remain robust for U.S. corporate credit. The reprieve that we will get from corporate supply will likely be a bit of a technical support mechanism in the next few weeks, I would say, until we get past the next earnings season. But it'll probably look to pick up as I think corporates will opportunistically take advantage of the strong tone to refinance upcoming maturities and really make sure their capital structures are in order.
Amanda, great to have you with us, and context there, yeah, back up in yield. A lot of deployers will be licking their lips. Amanda Lynham there, Michael Purvis. My guest this morning setting the stage for a big week in central banks. Coming up on the show, your morning calls, and it is a monster week for big tech. The conversation still ahead with LPL Financial's Quincy Crosby joins me for the Woodstock of AI preview. That is the NVIDIA gathering today.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's get you some of your morning calls from Wall Street. First up, HSBC raises NVIDIA's price target to $1,050, highlighting the company's pricing power and the best-in-class AI pipeline. Next up, Williams downgrades Nike to a sell. That's ahead of the earnings, expecting the results to reveal weakening sales growth and also pressure on the margins. Finally, Morgan Stanley upgrades PepsiCo to overweight, pointing to a compelling valuation and an underappreciated global strength and reach. Coming up, Quincy Crosby joins me as we head into this opening bell on why stocks could be set for a pullback. That's a conversation you maybe want to tune into in the next couple of minutes. No sign of it at the moment.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Counting down to the open in the next couple of seconds. We have a tech tinge this morning, helping us claw back some of the losses in the latter part of last week. You've got Alphabet going bid on the back of a potential deal with Apple to go into the iPhones. Will that go through at a regulatory level? NVIDIA is the Woodstock of AI today. Had to be a boomer that wrote that. Somebody just sent that in on the ticker to me. There you go. They're happy of the nicey this morning, 52.25. I mean, is there any smell of a pullback at all? What happens if these rates do go above 432? According to Mike Wilson over at Morgan Stanley, that is an inflection point at which equities would need to reflect more carefully. There are your yields this morning, up a pip at 432. Mike Wilson makes the point, this is a moment of inflection of where equity, the power of the equity rally may well be challenged by those slightly higher rates, up 24 basis points last week. Crude is up 0.7%. We just had Michael Purvis with us talking about the rally in crude since the Powell pivot. It is a headwind in the inflation story. Dollar yen, it's going to be a big day. They say tomorrow could be the Bank of Japan exits its negative rates. The yen continues to decline, and the dollar has been for the 5th day in a row, so FX is not giving you the classic reaction. I mentioned one stock at the start. Of course, it is Alphabet and Apple. The tech giant is in talks to build Google's Gemini AI engine into the iPhone. That's according to Bloomberg reporting. Abigail Doolittle is with me on the details. Could be a big old move for Apple and for Alphabet.
A big move for both of these companies, a continuation of other partnerships they have, or I would say a new growth of a new partnership for these two companies. But these stocks, investors really liking it. Apple having its best day since the middle of January. Google, Alphabet having its best day since July of last year. So the deal that you're talking about, and of course was a Bloomberg exclusive, Apple is in talks to build Google's Gemini AI engine into its iPhone. Sources are saying that these two companies are in active negotiations to let Apple license Gemini to power some of the new features coming to its iPhone, the operating system, this year. Now, Apple has also apparently had discussions with OpenAI and has considered using its model. Apple CEO Tim Cook has promised a big AI announcement this year. Now, if a deal between Apple and Alphabet comes to fruition, it would really build upon, I was mentioning another partnership, the two companies' search partnership. Alphabet pays Apple billions of dollars each year to make its search engine the default option within Safari on its iPhone and other applications. Now, these talks could suggest that Apple's AI efforts are a little bit behind the curve, and while this potential deal would give Gemini a big edge with billions of users, one thing seems clear, Manus, it could really shake up the AI landscape.
Yep, it sure could. Abby, thank you very much. Let's turn our attention to the other part of this analysis. It's the CHIPS, NVIDIA's GPU Technology Conference. Kicks off today in San Jose. Some are calling it the AI of Woodstock. Alex Webb is with me. I've had various IBs on this, is that the only person that could have dubbed it that was a boomer. So that's an irony for one of the biggest advances in our lifetime. So what are we going to get today? Is Jensen Huang's speech as equivalent to Powell is on macro policy?
I'm not sure I'd be quite that generous about it. Look, clearly 2 years ago, people wouldn't have even blinked at this conference, the vast majority. Even a year ago, I'm not sure it would have garnered quite this much attention. But of course, we've seen over the past 12 months the extent to which NVIDIA has driven or contributed to the rally, but also how important its technology is to underpin so much of the innovation that we're seeing in artificial intelligence right now. Of course, the chips that have been doing that so far over the past 12 months or so are the B100. What we're expecting to see today is the H100, the next generation powering this. And not only is that important when it comes to the innovation piece, it's predicted to be as much as twice as efficient as the existing model lineup, but also when we look at the stock itself. Expectations are, of course, very high. It's trading, I think, something like 35 times its forward earnings, at least it was before today's open. In order to maintain and justify that pricing in the years ahead, it clearly needs to keep innovating in order to keep its what is right now market-leading position. There are lots of other companies, trying to clutch at its tail. As long as NVIDIA continues to extend its lead, that's going to be ever harder to do.
Okay, let's see what there is later on in the day to get our teeth into. Alex, thank you very much. Let's stick with tech. Tesla's jumping. The news is that the company, get this, that they're going to raise the price of their Model Y cars in April. Simone Foxman. So this is a bit of a shift in gears, excuse the pun. We're normally reporting price cuts, Simone. What do we think we're going to get?
Yeah, well, we're going to get, according to the company, which tweeted this late Friday night, a $1,000 increase to the price of the Model Y vehicles starting April 1st. Model Y, you may recall, is the midsize SUV. And this is a car that starts at just shy of $44,000 before tax breaks. I think we have to try and ask ourselves, though, why are we seeing this movement on prices? Is this a sign of demand? Is this a sign that the consumer can stomach higher prices? Well, the initial analyst reaction is no. In fact, Deutsche Bank and Evercore ISI both saying that this is likely a marketing push to try and sell more vehicles before the end of the first quarter, which ends at the end of March, because both of them say first quarter deliveries appear weak. You may remember that Wells Fargo last week predicting zero growth for Tesla in sales this year and actual volume declines next year. So simply trying to get the cars off the lots right now. Also, I should note, just in the last couple of minutes, last hour or so, we saw the publication of a Don Lemon interview with Elon Musk, who said his prescribed use of ketamine, which alleviates periods of low mood for him, is in the best interest of investors in Tesla, as well as the other company he runs. This follows, of course, concerns about his recreational drug use, according to various reports, that not impacting Tesla shares at the moment as much as the news of these price hikes, which so far today has been a positive, Manus.
Okay, Simone, stock is nicely bid, up 2.3%. Simone Foxman there on the Tesla latest. Let's turn to another story now. They've got a high-profile split. FedEx and Amazon, they've explored doing more business with each other. That's according to the Journal, the Wall Street Journal. Katie Geifeld is with me on this story. What have we got here?
Yeah, an interesting story out of the Wall Street Journal reporting that last year, the two companies, they had discussed FedEx accepting returns of Amazon packages at their retail locations. This, of course, was according to people familiar with the matter. And while Amazon has a partnership with many companies, including with UPS, for example, the FedEx and Amazon talks, they ultimately didn't reach a deal. Now, remember, FedEx had a partnership with Amazon years ago, but in 2019, FedEx ended delivery contracts to move Amazon packages, and that was, of course, as Amazon's competitive threat grew and has only grown since. And it appears that these talks restarted last year as FedEx really seeks to boost parcel volumes. And that will be the storyline to follow this week when FedEx reports earnings. Analysts expect that revenue will shrink for a 6th straight quarter. That is before a potential pickup next quarter. Those earnings hit on Thursday afternoon, Manus, so stay tuned.
Okay, well, eyes down for that. It's going to be a busy week from the macro to the micro. Now, StoneX, I should say, are discussing the craziness of the stock market at the moment. This is what they've got to say. It's like being high on drugs. The markets take the best of the AI story, the best of the disinflation story, the best of the growth story, and project that for ever. Quincy Crosby is my guest this morning from LPL Financial, joining me now. Is that where we are? Are we in this forward projection mania, Quincy, or could the bond backup interrupt our enthusiasm? Good morning.
Good morning. Yeah, no, absolutely. You know, there's the yield line in the sand for the equity market, and we've been looking at, say, 4.3 on the 10-year. The market so far has been almost immune to the inching higher of the yields, but at some point, we may be getting closer to that the market is going to have to pull back and actually do something that we've been waiting for, and that is consolidate. The market's been overbought. We need a consolidation. Overbought markets can keep going, but something typically comes along to just let them start pulling back and digesting those gains. It could be from the Fed, the commentary. If they don't assuage market fears that there could be absolutely no rate cuts this year, we could actually see the yield climb higher, the equity market pull back. But you know what? Getting back to NVIDIA, they came in their last earnings when we thought we were going to have a nice consolidation and gave the market a major reason to go higher when they announced the earnings and the CEO's famous quote, "We are at the tipping point for AI." They could do it again this week at 4 o'clock Eastern with the CEO's commentary, which is supposed to last a bit, or if we hear the term name Blackwell coming in, because that's supposedly the new name, the successor to Hopper. But the point is, at some point, the market really needs to just come back, adjust, recalibrate, and the Fed may give them that, and maybe they will be again helped by NVIDIA.
Do you think, Quincy, that really, if there is an adjustment in the dots, it's only going to take 2 Fed members to move their dots, to shift the narrative and the dialogue of what we're all going to talk about, which is perhaps shifting to 2 rate cuts, the median outlook to 2 rate cuts. That in of itself is probably not going to be enough to shake stocks.
No, it won't be. But what we're also seeing is that some of the dubs have actually moved in the camp of perhaps maybe 1 little rate cut and then we pause. That would be Bostic of the Atlanta Fed. But the point is the market has been underpinned by a notion that the Fed will keep going and cutting rates. Something has to take its place, and that will come from the earnings season, and we have a bit to go. Something has to take the place of those rate cuts. The valuations are so high now for the market that you need lower rates to underpin that higher valuation. And that's the issue overall for the market. The market will find its equilibrium. It always does. The question is not if, but when.
The concern is that at some juncture, the savings rate comes to bite the consumer in the United States of America. That savings rate has been dropping. Unemployment remains sub 4%. Wages are rising. So the third leg of that stool is the ability to spend. And if that savings rate is beginning to dissipate, is that something which only kicks in, that's got a longer lead time before it challenges the robustness of the consumer?
Well, absolutely. But, you know, when we look at the spending, most of it is coming from upper wage earners and those who feel safe with their jobs. One of the things we are seeing is that the companies are increasingly looking at the white collar workers. We see it in tech. We see it in the financial services. If that spreads across the broader spectrum for corporate America, you are going to see consumer spending come down. All you need to see is a higher unemployment rate, where it's coming from. No one feels sorry for tech workers or those being let go from Wall Street. But if it hits the broader spectrum of names that the Americans know, where they're cutting workers, they will pull back spending. It invariably, every historical pattern indicates that, but we're not there yet. Spending continues. It is the higher wage earner that continues, but the higher wage earner is under the microscope from corporate America right now.
There's a couple of major tech stories which we're focusing on this morning. We're going to spend some time on Apple and Alphabet, perhaps commingling the AI functionality of Gemini from Alphabet into the next iteration of the iPhone. We've got, as you said, the AI, the Woodstock of AI a little bit later on today with NVIDIA. When you look at the narrative to try and broaden your reach beyond the Magnificent Seven, how important is it for Apple to get a deal that changes the narrative around their AI proposition?
Apple has to do something. They know it. They're losing market share in China. That is going to continue. They have been almost deemed a value stock at this point. But one thing Apple does is they make money. They've got cash. They could come in and make an announcement of a major share buyback in conjunction with a new move towards AI. I think the Gemini deal is just one of many. They're not going to sit back and be relegated to a value stock. They understand that the market is waiting, and they will. I mean, the shutdown of the vehicle, the move towards a vehicle, was incredibly important, but they are shifting. They have been letting people go in other parts of the company to move more folks into AI. They just bought a company in Canada that is completely focused on AI. This is not going to deter Apple. They know that this is important, and investors are prepared to go into NVIDIA, go into all of the companies that NVIDIA basically underpins. They have a broad ecosystem of companies that once they shed light on another company, those share prices go up. And NVIDIA will be buying more companies. Apple has to do something. They know it, and they probably will.
Go big, go bold, or go home. That's what they used to say at work. Quincy, thank you very much, Quincy Crosby.
Thank you.
Thank you so much for being with me this morning. Coming up, as Quincy has just been talking about, investors are bracing for the AI of Woodstock.
Look, we believe it's a 1995 moment. This AI revolution, this party, it's getting the popcorn out. It's 10 p.m. in a party that goes till 4:30 a.m.
It's going to be a big party. We'll look ahead to that NVIDIA AI conference today on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
We believe it's a 1995 moment. This AI revolution, this party, it's getting the popcorn out. It's 10 p.m. in a party that goes till 4:30 a.m. This is now starting for the software sector, that AI momentum. This tech bull market continues to, I believe, go higher because of numbers, but it's going to be software-led.
The AI industry facing a possible shakeup. Bloomberg learned that Apple is in talks to build Google's artificial intelligence engine, Gemini, into the iPhone, setting the stage for a blockbuster agreement. Meanwhile, you've got NVIDIA facing its latest test as the company's AI conference kicks off today. Alex Webb is with me now. Alex, I look at the market's reaction to the potential Apple-Alphabet relationship, and the alpha response is in the Alphabet stock price, not Apple. So if this is supposed to be seen as some kind of an AI salvation moment for Apple, it's not reflected in the price.
I mean, Apple is still trading up a bit, but of course it is giving a certain amount of ownership of the interaction to Google. And that will mean, potentially, if this deal is signed, that Google has the single most dominant position in mobile devices when it comes to that interface. Apple's main competitor in mobile device operating systems is Android. That is, of course, developed and distributed by Google. So it gives Google a real lock on that keyword. I won't say it because I don't want to set off all the people's phones out there, but if you say the keyword for Siri or for the Google Assistant, you're likely to be getting a Google AI interface or AI technology in response.
I mean, do you have any vision of how this might work? I mean, it'll certainly help, let's say, with day-to-day. There's Apple up 2.77%, Alphabet up 7%. Is this about the access to the 2 billion iPhones and where this AI and the ChatGPT functionality escalates and evolves to?
It's going to be, well, look, we don't have the full details, so let's caveat everything with that. The way that Apple has a relationship right now with Google in search is that Google pays Apple for the privilege of being the default search engine in the iPhone. I suspect that in this case of Gemini, it is far more likely to be that Apple pays Google for their technology. It is something that it is going to be this sort of medium through which you are able to interface with parts of the phone. I'm really interested to see how this works technologically. If you use ChatGPT, it is quite laggy. You're not getting a response inside 5 seconds in many cases. That there's a huge amount of compute power. Perhaps we'll get onto NVIDIA, but that is driven largely by NVIDIA. It has to go off to the cloud, be thought about in the cloud, and then delivered back to the phone. On the whole,
In terms of what today is there, NVIDIA stock is up over 5% as we speak. Let's just check in on the price at the moment. Let's see what Jensen Huang has got to say to the market later on today in terms of chip and AI development. 4.28% now is where we are, up over 5% on the day. Abby is with me to round out the sectors for this Monday morning session. Abby.
Well, we are looking at a very strong session with the S&P 500 up about 0.8%. That's the best day since March 12th, so about a week or so. Apple, though, having its best day since mid-January, as you were mentioning, up more than 2%. Google up 7%, its best day since February of 2023. Not surprisingly, communication services then, which Google Alphabet is a part of, up 3.2%. Tech right behind it, up 1.7%. Utilities, financial and healthcare, the fact that those are on the bottom of the pile, that's actually risk on because those are some of the more defensive sectors. Let's take another look at that communication services surge. If we take a look at it in the context of over the last few days, well, there it is. Parabolic uptrend on the day, up 3.9%. Folks really want in on Alphabet on this possible AI deal with Apple.
What a beautiful word, parabolic. There we go. Straight up she goes. Abigail Doolittle on the sectors. Coming up on the show, market moving events to set your trading diary by.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Some huge monetary policy decisions to be made this week globally, no more so than in the Fed. And if we are scaled back to 2 rate cuts in the dots, that's perhaps injurious to the wider economy. Look at this NASDAQ, clawing back, powering ahead. NVIDIA and Alphabet are the two single biggest drivers of this. If Alphabet gets on board with Apple to disseminate their technology, their AI technology through the iPhone, and NVIDIA will hear more about the chips that they are going to launch later today, the AI, the Woodstock AI equivalent. Some other notes for you. We've got NAHB Housing Market Index at the top of the hour. Also, that conference begins later on. We'll bring you the news flow from that. Tomorrow it is about the Bank of Japan and a slew of central bank decisions. Wednesday, it's the Fed's turn, plus Chade Powell's speech and news conference. And then the Bank of England on Thursday.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Everybody's bailing on me this week. Tom Keene gone. I don't know where he is. He's on holiday somewhere. Alex Steele, she's actually out working. She's on assignment. I'm not sure where. I'm going to guess Houston because that's what she does. She does all the energy stuff. So sitting in for Alex, how about this? John Tucker for 2 hours.
This is only my second job this morning.
Yes, exactly. John he wears 4 or 5 hats here at Bloomberg Radio. Nothing happens without him. So we appreciate getting John for a couple hours here. Coming up, we're going to talk to Tom Giles. He's the senior guy at Bloomberg News on all things technology. Get his thoughts on what's happening potentially between Apple and Google on the AI front. That's been a real big story. And then we're going to get a markets call with our good friend David Dietz. He's a senior investment strategist at PPAC Private Wealth. He's always got some calls on these markets and some names as well. Let's kick this hour off with Lisa Mateo.
You got it. Stocks advancing after Wall Street wrapped up a second straight losing week with additional losses. Right now, we do have the Nasdaq up more than 1%. S&P 500 up about 0.8%. The Dow up about 0.2%. The 2-year yield, that's little change at 4.73%. The 10-year yield at 4.32%. That's up about 1 basis point. Over to commodity spot gold higher at $2,158 an ounce. And oil advancing on strong China data. We have NYMEX crude $81 a barrel, Brent crude at $85 a barrel. This week, of course, the Fed in focus. Policymakers kicking off a 2-day meeting on interest rates. Now, they'll announce their decision on Wednesday. Analysts are saying they're likely to keep rates on hold for a 5th straight time. We shall see. But many eyes on NVIDIA today, the company kicking off its annual GTC Tech Conference. Opening comments from CEO Jensen Huang. Everybody's looking forward for that. NVIDIA shares right now, they're up more than 3%. That is your Bloomberg Business Flash. Back to you.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast. And we're also in the dashboard thing, the CarPlay, the Android radio, and it's all up there, John.
I don't know if I get that. I have my Philco.
You have your Philco. Okay, you got your AM, FM, back and forth. That's all
No,
you
just AM in my car.
AM 1130. Market Drivers today is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. Good start to the week here today. The S&P 500 up about 0.9%. The NASDAQ up about 1.3%. Let's break it down with Abigail Doolittle. She does all the markets for Bloomberg News, radio, TV. She does it all. She joins us here in our Bloomberg Interactive Broker Studio. Abigail, what are you looking at today?
The strength of the session. We have that NASDAQ 100 up in a big way, as you were just mentioning. The NASDAQ 100 outperforming up 1.4%. And this a lot having to do with Apple and Alphabet both soaring on reports, a Bloomberg exclusive, that Apple may include Google's Gemini for its AI features in its upcoming operating system. Now, relative to Google, the last time I looked, the stock was having its best day since February of 2023 at the highs, up 7.8%, the best day going back to April of 2020. So people are really biting into this, the idea that Apple will have the 2 billion iPhone users. It will give Gemini, which to my ability to tell so far in the AI race has been seen as the laggard. Yeah. This could, suddenly put it very much forward and kind of shake up the whole AI landscape.
But is it an admission on the part of Apple that maybe we're not up to speed on this, that we have to bring in a partner?
It certainly is, but the fact that you have Apple up, or at least that would be my interpretation of it, Apple's up 2.4%, it's best day since January of 18. It seems as though investors, they don't care, just so long as they have a plan to address AI and bring it onto their devices.
Now, it's not the first time they've partnered up.
No, because they, of course, have the search partnership with Google. Google pays them. And, you have to wonder, is that a piece of why? Because apparently Apple also spoke to OpenAI. Is this a part of the reason? Because Google pays them billions of dollars every year for Google search to be the default within Safari.
And just in a couple moments, we're going to get some more reporting on this. Tom Giles, Bloomberg News Senior Executive Editor for Global Technologies. He's based out in San Francisco. He knows everybody. His reporters know everybody. His reporters broke this news out there, so we'll get some more reporting on that. So, Abigail, what's your thoughts of this market broadly defined here? I don't know how you want to answer that, but whether it's a technical or fundamentals, when you look at this market, what are you seeing out there?
So I think that everyone is waiting for the Fed meeting this Wednesday. And when I take a look at the NASDAQ 100 from its last high, which was not that long ago, March 8th, we are in a small series, but a series of lower highs and lower lows, which tells us that since March 8th, the sellers have basically been in control. Even with today's rally, it's still a lower low. I think what this could come down to relative to the Fed is the Fed, will the FOMC policy statement and the subsequent press conference confirm the idea that 2024 is a year of cutting? Because we, of course, have had some hot CPI data. We've had some notable Wall Street analysts and strategists talking about the idea that there may not be any cuts this year. I think that investors will be reassured so long as there is at least one cut, preferably the 3. But you have to remember, late last year, Wall Street was looking for 6 to 7 cuts. The Fed wasn't talking about any cuts. It was in the dot plot, and then the Fed said 3, and so here we have Wall Street 3. So if
and yet we still have powered higher, as if maybe the Fed is in the back seat, in the front seat.
I think that that's the assumption that they will be cutting. If there's any indication, if Fed Chair Jay Powell gives any indication, you know what, folks, it's not going to be June. It may be the fall. It's the presidential election. That might put us on hold. We're concerned about this sticky inflation. I'm not saying he's going to say that, but if there's any indication of that, I think you're going to see a very serious repricing of risk. And we have already seen it in bonds. That 2-year yield at 4.73, the 10-year yield at 4.31. I mean, so the 2-year yield is just about 25 basis points away from 5%.
Yeah, well, that kind of snuck up on me.
Yeah.
Maybe because I was stuck at 10,000 feet for the last week skiing.
Oh, poor you.
Poor me, exactly. When you talk to your sources, Abigail, in the marketplace, are folks scaling this wall of worry? Did they feel like my upside risk is still better than my upside opportunity is still better than my downside risk? What's the sentiment out there?
I think that there's a big divergence. I think that there is one camp, and this is less in terms of what people are actually doing with money, but more opinion on. So at the end of the day, it does come down to where people put their money. But I think that there's one camp that really think frothy, too far, too fast. I mean, NVIDIA, it is the poster child for this. This year, basically a double. I mean, it's pulled back a little bit since then, but basically a double. Super microcomputer, which was added into the S&P 500 officially today, up about 1,200% from in 1 year. I mean, if that's not nuts, I don't know what is. Now, there's no question that AI is going to be a powerful driver of future efficiencies. Is it going to be the internet? My personal opinion, just my opinion, no. I think that it's something better than blockchain, but I think it's less than the internet. Right now, it's being priced as though it's like the internet on steroids. So I think that there could be a moment of pause. I mean, that's just, you know, a non-tech opinion. But at the end of the day, it's going to come down to the Fed. If the Fed suggests that liquidity is not coming back into the market, there's going to be a repricing of risk for stocks.
All right, Abigail, thank you so much for joining us. As always, appreciate getting your thoughts. So Abigail Doolittle, she covers all the markets for Bloomberg. And again, just looking at super microcomputers. I never even heard of this name before it came into the news. Up 277% year to date, up over 1,000%.
What's the ticker on this?
Yeah, exactly. SMCI. I know. I'm just looking at like who the management, like how much stock did they own here? That's nice. Somebody's had a nice move there, you know, in terms of their pocketbook. So, but I guess it's in the S&P 500 or whatever. So I guess now it's the stamp of approval.
Now you got to buy it. So
yeah. So all right. So here's the story of the day. First of all, John, I know you're the AI expert here at Bloomberg Radio, but some nice news out of here. Some dude we got at Bloomberg News. He's out in California somewhere, Mark Gurman. He's pretty good on this Apple thing. Which is a pretty good career move for him. And he just creates a story. You put Apple in a story with Google. This is an alphabet-free zone. Apple and Google in a story. That's going to be big news.
That's a lot of market cap there.
That's a lot of market cap. Then you throw in AI. Then you got something. Then you get something that's called a green bee, which I think is good for if you're one of those reporter geeks, right?
Absolutely.
Okay, very good. Tom Giles, speaking of reporter geeks, he joins us here. He heads up all of our technology news coverage at Bloomberg News. Huge job. He's got a great team of reporters working for him.
I timed my visit well.
Exactly.
I timed my visit around Mark Gurman's scoops.
Mark Gurman scoops. Tom, what do you make of this reporting coming out of Mr. Gurman here about Apple, about Alphabet, and about AI? What do you think's happening here?
This is Apple recognizing that it needs to weave artificial intelligence more deeply, more intelligently into its products, into the iPhone. It already has this really long-standing, deep, very lucrative relationship with Google in terms of putting Google search, making it very paramount on the iPhone. This is, let's take it to the next step. Let's take this relationship further. And let's weave your generative AI tools into what we have on the iPhone and make it better and make it smarter. Let's leverage this relationship. Also, it's important to note that Apple is seen as a laggard when it comes to artificial intelligence. Everyone's got something big. Every big tech company has a big AI story. Apple is seen as a laggard in that.
And this is an admission in some way that AI, Apple can't do it by themselves.
That's right. You don't get
so why would the stock be higher?
You don't get to build this from scratch. I think there's a few things at work here. One is regulators are already looking at the relationship between Apple and Google. They don't like aspects of it. DOJ is looking hard at that. The FTC is already looking at the relationship between Microsoft and OpenAI. The concern is there's innovation happening in artificial intelligence, and if you have combinations between the biggest players in tech, the most powerful players in tech, is that going to thwart innovation, and is it going to thwart competition?
So how do we think the regulators might look at something like this?
I think they need to figure out whether the talks are going to come to fruition, first and foremost. We're definitely sending out feelers throughout the Bloomberg organization to figure out what the next step is and to assess what the argument would be for and against if you're a regulator. But if you're a regulator, think about it. If you're at the DOJ, if you're at the FTC, do you want to see more concentration, more collaboration between the two most powerful companies in the world? Or do you want to say to them, Apple, go and build your own?
How long does this relationship last? If Apple finds a better partner, could they drop Google like a hot rock?
We know, as we reported, Apple held talks with OpenAI. We also know that the talks that are existing now are the ones between Apple and Google. Could you kind of rekindle something? Could you start something up with somebody else? I think the sky's the limit here. Apple needs something big. They need something new. They need the iPhone has been around, as we all know, since 2007. They need a big new thing. They need that next big thing. Remember, they were working on a car.
Yep.
As Bloomberg told you a couple of months ago, that project, it's actually just been a few weeks, that project is now being killed. They're going to redeploy some of those people into AI initiatives, but they need that next big thing. And weaving AI into your iPhone could be one of them.
So Apple also has a developer conference, I believe in June, Tom, and a lot of folks think that maybe that's the time Tim Cook's going to get up on stage and say, here's our AI play. Is this part of it? Is this, it seems like, as John was suggesting, this is kind of admission, we don't have that big, oh wow moment for you. How are you thinking about that?
It takes a lot of time, it takes a lot of people, it takes a lot of resources to build these large language models upon which generative AI tools are based, right? OpenAI was not created yesterday. They've made a big splash in the last year, but that was years in the making. Microsoft's relationship with OpenAI works to their advantage. Google has been working on its own generative AI technology for many, many years. That was not top priority for Apple for all this time. They've been working on the phone, they've been working on the watch, they've been working on the car, they've been working on all these things that we use and are very lucrative for them and are making them one of the biggest and most valuable companies in the world. But this was not the biggest area of concentration for them, at least not as much as other companies. It takes time. My sense is you can, even if you haven't nailed down all of your details on a relationship like this, you can still use your developer conference to drop hints, to say, here's what's coming down the pike, here's a taste of it, even if it's not completely. They like to have stuff that's pretty baked before they start talking about it publicly. So I don't think they're going to jump the gun here, but it would be nice to have this in your back pocket to at least drop some hints.
Okay, so what does it do to my iPhone, and do I now have to go out and buy a new model iPhone? What does it do for sales, and what's the practical impact for an iPhone user?
Look, we're already using our phones for virtually everything throughout the day. These are like, it's the one thing that you would take if you're running out of the house with a fire, right? It would be things like creating images, writing essays, the things that we are already using tools like OpenAI for. Could you more easily incorporate those into your iPhone so that you don't have to fire up the laptop, so that you don't have to delve into a different app? Could you weave this into the tools that you already have right on your phone?
Something like 5G, like everybody told me I had to upgrade my phone to go to 5G. I didn't even notice it. It's like, I don't know what it does for me.
You're happy with 3G, let's be honest.
This is different.
All right, Tom Giles, thanks so much for joining us. Tom's based in San Francisco. We got him in New York for a week, so we pulled him into the studio here. Tom Giles, Bloomberg News Senior Global... Let me go back here. Bloomberg News Senior Executive Editor for Global Technology. There we go. He's got a whole bunch of great technology reporters on his team. They're doing some good stuff. So, John, you know me. I'm a Wall Street guy. I'm a money guy. That's really all I care about. So I go to Rich Go, because I'm looking at this super microcomputer, again, up tenfold over the last year. Charles Liang, who's a founder, chairman, he's the largest shareholder. He's got, a bunch of stock. His net worth today is $8.3 billion. That puts him number 307 on the Bloomberg on rich list.
That's the thing. It only puts him at 307.
Of his $8.3 billion, $6.4 billion came just this year. So, I mean, the dude is just I mean, there is the real winner.
Unlike me, he's having a really good start to the year.
He's having a really good start to the year. So again, super micro computer. It's now got a market cap of just about $60 billion. And Charles Liang is the chairman there, and he's having a good year as he owns over 1.1 million shares. So good for him. S&P 500 up a solid stick, up 1%. The NASDAQ up 1.5%. Yields 2-year Treasury 4.72, pretty much flat there. The 10-year 4.31. And WTI crude oil a little bit higher, $81.53 per gallon. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks off to a pretty decent start in this new trading week. We have the S&P 500 up more than 1%, the NASDAQ up more than 1.5%. And that's leading the advance right now. Of the 11 major industry groups, the biggest push coming from communication services. And if you dig deeper, it goes into media and entertainment. further under the hood to its interactive media and services, where Alphabet is at the top right now. There's some news today surrounding the company. Alphabet right now up more than 6%. Sources are saying Apple in talks about Google's Gemini AI engine. Into the iPhone, we have Apple. They are up about 2%. That is your Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate it. John Tucker doing his best to sit in for the Alex Steele. We appreciate the effort.
Can anyone really substitute for her?
Yeah, so she's on assignment. I'm guessing somewhere in energy country, badgering some CEOs of some energy companies. She'll be back later this week. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. John, it just feels like a market that just wants to continue to grind higher here with the S&P up another 1% today. Let's check in with David Dietz. He's a senior investment strategist, PPAC Private Wealth Management. Hey, David, again, you turn around, there's some angst about the Fed. How much will the Fed cut this year? It seems to be less than when we started the year. That being said, markets are still moving higher. I'm not sure the earnings are pushing them higher. What's your take here in mid-March, David?
Well, there's so many tailwinds and behind the market right now, and I think investors need to realize that some of the reasons that the Fed is expected to be in no rush to cut interest rates is because of these themes that are actually helping push stocks higher. What do we mean by that? We still have a strong economy. A year ago at this time, we were all on tenterhooks looking for that recession. Now we're talking about continued economic positive growth here in the first quarter. Unemployment still has a 3 handle. Remember that consumer is 70% of the economy. As long as the consumer has a job and feels they can find another job, they're going to keep spending. And of course, interest rates have come down. They've edged up here a little bit this year, but I mean, remember in October, we were facing the highest interest rates in decades. And now, of course, they've come down on the 10-year, for example, down about 1%. So those things are pushing the market higher. And so as a result, with the good economy, the good stock market, the Fed's going to be in no rush to reduce interest rates.
Yeah, I almost feel like we have to come up with a subcategory of bullishness. The frustrated bulls, the reluctant bulls. Are you all in? What kind of a bull are you, David?
So, I mean, we are, of course, in just 1.1% off of all-time highs. Sentiment really is positive. You look at, and there's some speculative excess. I mean, look what's going on with Bitcoin. How do you explain its big move in the last 6 months and so forth? So I do think that investors need to be overall cautious. Having said that, of course, once you go beyond those mega cap tech names, you are seeing more reasonable valuations, particularly in the mid caps, particularly in the small caps. Of course, overseas is still a place most people don't want to go, but we're seeing life there. Of course, look what's happening over in the Japanese stock market. So I think that you still want to stay invested, but I do think you want to take some profits off of those mega cap tech names and re-diversify.
All right, if I re-diversify, how about real estate? Do I think about the REIT sector? I mean, if I think REITs are going to come down, if I think rates are going to come down, is that good for real estate?
Well, absolutely. Most real estate, of course, is bought on leverage. And, of course, the REIT sector has been down over the last 18 months because the higher rollover costs with the interest rates having moved up. But the bullish case for REITs would be that a lot of that is now priced in. And if, in fact, we continue to see over the longer haul inflation coming down, the Fed being less hawkish at some point cutting rates, that's got to be manna from heaven for real estate. I think the other opportunity is that there's tremendous fear in that office space segment. And a part of that, of course, is the failure for all employees to come back to work with the rise in hybrid and remote work models. But again, not all REITs focus on that area. So I think a lot of investors are painted with a broad brush. And I think if you look stock by stock, you can find REITs that don't have that office real estate exposure and take advantage of their lower prices.
What is your opinion right now of emerging markets and the opportunities that may or may not exist there?
Well, here's the thing. Everyone frets about high valuations and stocks have done well. And when an asset class comes down, they find so many reasons to say, yeah, but not now. Of course, I think your big 800-pound gorilla when you talk about emerging markets is China. Remember, China is about 1/3 of those emerging market indexes. And it is to the extent that we're not comfortable with China, we've got those geopolitical tensions. Will they or will they not invade or pick on Taiwan? Will they be too heavy-handed with their regulation in the tech space? Can they properly rebound from a heavy-handed approach to COVID-19? Those are things we're watching. On the other hand, many of their blue chip tech stocks are trading between 8 and 15 times earnings, huge discounts to what we've got here. And of course, it's a huge population. It's still growing faster than the United States. So I think investors could be well advised to shift some of their winnings for these mega cap techs in the U.S. over to the emerging markets, including in order to get some exposure to China.
One of the names, David, on your list is Pfizer. PFE is the ticker to put into your Bloomberg terminal. And of course, this was obviously a huge pandemic play. They came up with the vaccine. We appreciate that. We thank them for that big time. What do we do now with a Pfizer here, kind of post-COVID?
Well, I would take the lead of Albert Bourlas, who is the very well-respected CEO of Pfizer, and buy more Pfizer stock. First of all, you're paying about half of what it was during the COVID-19 pandemic era. Pfizer, as you noted, with BioNTech, of course, helped us get out of COVID-19 with their vaccine. But now, since there was no immediate encore, the stock has been sold off tremendously. But now you've got close to a 6% dividend from a global pharma blue chip. Remember, some of these big pharma companies, they're not all about R&D. They're also about marketing and global reach. That's what Pfizer is. So what we're looking for Pfizer here is potentially, if they can develop something that like Eli Lilly or Novo Nordisk has, some sort of treatment for weight loss, you're going to see this stock rise dramatically. And of course, in the meantime, for example, Pfizer's in the news today. They are reducing their exposure to one of the spin-offs from GSK. That's going to bring them in $2 billion. I imagine they're going to use a lot of that to buy back stock. So they're doing what's necessary and what makes sense as they look for better results. Remember, they just closed on the deal with Seagen in December, $43 billion deal for an oncology specialist. That's where some of the big money is. So we think a lot of the negative news has been priced into Pfizer, and you could see some return over the next few years to that all-time high above 60.
And David, the need for fossil fuels doesn't seem to be going away anytime soon. And if that's the case, the oil services companies aren't going away anytime soon either.
Unfortunately, you are absolutely right. And so as a result, we're looking for some energy companies which are also kind of mini tech plays. That's why we like SLB, formerly known as Schlumberger. They're an oil field specialist, largest in the world, and they're using technology to help some of the big names, your Chevrons, your Exxons, and foreign oil companies access those fields, particularly underwater. Very high-tech intensive. SLB is the leader there. It's trading about 13 times earnings, far cheaper than it has in the past. We think this is a high-quality play for, unfortunately, a longer period that we're going to be reliant on fossil fuels.
All right, David, thanks so much for joining us. David Dietz, Senior Investment Strategist for PPAC Private Wealth Management. John, you're talking energy with SLB, formerly known as Schlumberger.
I didn't know. When did they change their name?
I don't know. It's some consultant. I mean, that's always been their ticker, but now they're changing it, and they get very upset if you mention Schlumberger. So
I used to call it Schlumberger.
Schlumberger. Yeah, you didn't have the French going. But I'm looking at gasoline, and you're a guy here since you drive 1,700 miles a day round trip. Daily national average gasoline prices up 13% from that low back in December. That kind of gets your attention.
We were paying below $3 a gallon at the Wawa, but now I think it's like $3.15. It's getting higher. So
I mean, that
hurts.
That hurts, and that's kind of the inflation thing. I mean, I don't care how you phrase the question, but you go out there, and it's what you pay at the supermarket/restaurant for food, and then what you pay for gas. I mean, those are the big ones, right?
The big one for me, not just gas. Well, I drive a lot. Michael Barr drives even more than me.
Ridiculous.
But
Eastern Ohio.
The food bill is astronomical at the supermarket.
Yep. And that stuff's it's not coming down. So what I learned today, we had a discussion earlier today with Jess Menton. She wrote an article about the consumer products companies, the Mondelez and the Kraft Heinz. when their input costs go down, like wheat and corn and that kind of stuff, they don't cut the price of Oreos. But they give you incentives like coupons to move the stuff off the shelf.
Oh, but
that's not the same thing.
Speaking of inflation, what were lift tickets out in Utah?
I literally closed my eyes when I gave him my credit card. That's how bad it is. I mean, so it is extraordinary. But I mean, you think about it. You look around at a ski resort, all you see is huge capital expenditures, lifts, and all that kind of stuff. The other thing you see is just millions of staff. You know, 3 or 4 people at the bottom of the lift, 3 or 4 people at the top of the lift, all the waiters and blah, 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 blah. The cost associated with running one of those things is out of control.
That's a lot of overhead.
That is a lot of overhead. So when but it's been brutal. I don't know how a family does it anymore. I don't know how my old man did it back in the day, but it's good stuff. All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul, Lisa, John. Former President Trump's campaign this morning is walking back comments made by Trump during a weekend rally in Dayton, Ohio, on President Biden's crackdown on gas car emissions in the auto industry. The fallout is from Trump using the word bloodbath.
We're going to put a 100% tariff on every single car that comes across the line, and you're not going to be able to sell those cars. If I get elected, now if I don't get elected, it's going to be a bloodbath for the whole, that's going to be the least of it.
A senior advisor for Trump's campaign says he was only talking about economics, writing Joe Biden's, quote, insane EV mandate will slaughter the American auto industry. Meanwhile, Donald Trump is expected to enlist Paul Manafort, the former campaign manager he pardoned, as a campaign advisor later this year. According to the Washington Post, it could include Manafort playing a role in fundraising for the presumptive GOP nominee. Israeli Prime Minister Benjamin Netanyahu has pushed back on Senate Majority Leader Chuck Schumer's call for an Israeli election. Bloomberg's Ed Baxter reports.
Netanyahu first says the aid issue to Gaza is complicated because when it does get in, Hamas loots it and uses it for its own gain. And on CNN, he says majority of Israelis support the government anyway.
I think what he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
Netanyahu also says its forces are trying to be careful, but that the move to remove Hamas will continue. Ed Baxter, Bloomberg Radio.
Russian President Vladimir Putin has won another 6-year term. Critics say it's a reflection of the preordained nature of the elections. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are advancing ahead of a big week for the Fed on interest rates. Now we have on the housing front, sentiment among U.S. home builders. Well, that climbed to an 8-month high in March. A few things contributed to that. You had a limited number of existing homes for sale and mortgage rates that are down from their peak. So we have the NASDAQ leading the charge. It's up more than 1.5% right now. The S&P 500 up more than 1%. The Dow up about 0.3%. Over to yields. The 2-year yield is little change at 4.73%. The 10-year yield up about 1 basis point at 4.32%. Over to commodities, we have spot gold higher at $2,160 an ounce, and oil, Brent crude at $85 a barrel. Also news about FedEx and Amazon. Wall Street Journal reporting the two companies looked into doing more business together, saying that they've talked about, FedEx accepting returns for Amazon packages at its retail locations, and that's something that actually UPS is doing for it right now. So we have FedEx shares, they're up about 0.3%. Amazon shares up 1%. That is your Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. John, I know you're not on TikTok.
Could you just imagine, the intersection of John Tucker and TikTok? What a disaster that would be. Stop laughing, Lisa.
Are you aware that there is this thing called TikTok?
Yeah, Charlie Pellett in the office shows it to me all the time.
Okay.
He said, it's great. Look, you can watch videos of, I'm like, this is the stupidest thing I've ever seen.
But the big issue here for a lot of folks is the ownership of TikTok, owned by ByteDance, which has Chinese ownership. So now there's a whole thing about, do you want these TikTok company and ByteDance having so much consumer information for Americans? And that's kind of the big issue here. So Matt Sheltonhelm, he joins us. He's a media litigation analyst. So he kind of does all the legal side for all this stuff in the media telecommunication space. He's a Bloomberg Intelligence. He's based down in Washington, D.C. Where else? Hey, Matt, give us the latest on what's coming out of Washington, either from a regulatory standpoint or maybe some movements from Congress about either forcing ByteDance to cease operations here or, maybe force the Chinese to sell it. Where are we?
Yeah, Paul. So some surprising momentum here on this issue. This first came up about a year ago in March when you'll remember Congress had a big hearing with TikTok CEO Shou Chew. It was really a tough hearing, and I think a lot of people thought it might lead to some drastic action sooner rather than later, and then everything slowed down. But then, sort of out of nowhere, about 10 days ago, the House introduced a new bill, then quickly passed that bill out of committee, and then passed it through on the whole House floor by a huge bipartisan majority. And basically, what this bill would do, if it were to clear Congress and President Biden were to sign it, and if it were to get through the courts, is to say that unless ByteDance divests TikTok to a less sensitive owner, that the application couldn't be hosted by internet hosts in the United States. It couldn't be on app stores in the United States. And there would be significant financial penalties, not for TikTok, but for those companies that would host it or that would include it in its app store if they were to ignore the legislation.
Well, we'll put on your Congress watching hat for a moment. What's the holdup in the Senate? What's the objection there?
Yeah, so I mean, it's amazing to see the bipartisan support this has. You don't see legislation move 352 to 65 like we saw last week in the House. You've seen senators on both sides say they want this. You've seen Chuck Schumer in the past, the Senate Majority Leader, say he likes the idea of requiring a change in ownership of TikTok. So that's exactly the question now. I think the holdup, though, is, look, this is an election year. And even though you've seen President Biden say, look, get it, if it comes to my desk, I'll sign it. He also has 150 million Americans using this app, many of them young people. At a time when you have an election coming in November, when every vote matters, in particular young people, to President Biden. So I think this legislation has a chance. I only give it a 30% chance, though, this year. And that's exactly because of the political risks of November at a time when President Biden doesn't want to risk a potential backlash from those young voters. The Senate is controlled by Democrats. Senator Chuck Schumer is the majority leader. He decides how quickly this moves. And I think the looming election is a reason to move slowly. But after that, after this election is out of the way, I'd be a little more nervous if I were TikTok.
So do we have any clear sense of what TikTok and ByteDance, how they're approaching this at this point? Like, what would they presumably do?
Yeah, so that's a great question. I think we've seen indications from China that it would not be willing to support a divestiture. Now, that could be posturing on that end. But I think there's the possibility that if the U.S. passes this legislation that requires a divestiture, or else there's an effective ban, there's a real possibility that China wouldn't allow any sort of divestiture like that to happen. So you're inevitably in the result of a ban. Of course, you're also in courts as soon as Congress passes this, and you saw Montana passed the TikTok ban last year. It got tripped up in court. You saw President Trump, before he was against this, he actually signed a ban of TikTok. That was tripped up in the court. So once this passes, you still have a tough court challenge coming. And so TikTok's first line of defense is going to be to sue over this.
All right, so if this ultimately goes to the courts, you got to explain to me what's the legitimate national security threat of me posting pictures of myself or video of myself, redoing my bathroom, or Lisa putting on her mascara.
That's exactly the question the courts are going to be asking. And one of the curious things about when the House voted on this in committee by that 50-0 vote is that they went into closed session.
Looks like we lost some audio. Matt Cheltenham, we lost some audio. Young man. This is one of the first things I did with Matt. We were seeing clients 6, 7, 8 years ago. We found out he had no cash in his pocket. And I said, why do you have no, how do you walk, you live in Washington.
Because you're not paying him enough.
You're up in D.C. He says, nobody carries cash. I'm like, what? He said, yeah, everything's on your phone. I'm like, so you don't have, it was just crazy. That's when I first kind of came into this, the kids don't have cash anymore. So anyway, so that's kind of my Matt Cheltenham story. But again, this is a big thing for TikTok because,
again, he didn't go away.
Oh, is he there?
So I think your earpiece cut out.
Oh.
You're being hacked by the Chinese, apparently. But Matt, pick up. You were talking about I was asking about what in God's name is the national security threat that's posed here that the courts are ultimately going to have to look at and determine. We've got about a minute left.
Absolutely. So the House went into closed session in committee when it talked about this. So they were secret on the concerns that motivated this, but then after they had that closed session, all of a sudden it was 50-0 voting in support. So we don't exactly know. I think the concern is that if this data is, not just you looking at your, cat videos or whatever it is, but 150 million Americans, everything that they are looking at, all of this flow of data going to China, let's China take a look at it. There's also a concern on the propaganda side that if China can impact sort of the flow of videos, can they start to shape thinking? And in particular in young people. So there's two sides of the concern here, looking at the data about how we're using it and also influencing thought potentially by framing messages, by using an algorithm to promote certain ideas.
I know I'd like to shape the thought of young people at this point, especially
that time has passed.
Youngsters in my house.
So Matt, following up on my story, how much cash do you have in your pocket today?
Oh man, I'm not walking around New York today. You taught me when I'm there, I'll be ready. Today I still just got my credit card.
He's got the credit cards and the phones. That's how they do it. All right, Matt, thanks so much on this. Matt is our go-to guy on all this litigation stuff about anything on the media entertainment front, and there's a lot of litigation out there. Matt's the attorney that follows that for Bloomberg Intelligence. He's based down in Washington, D.C., and investors really value his research on some of these big issues, and TikTok is a big issue. We'll have more coming up. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. It's a deal with the potential to shake up the AI industry. Bloomberg News learning that Apple in talks with Google to build its set of generative AI tools known as Gemini into the iPhone. Bloomberg's Alex Webb says there's two factors to consider.
On the one hand, you've got what it says about Apple's AI efforts in-house. The implication of that, clearly, they aren't progressing very well, at least as well as perhaps the company would expect. But the other piece of it is, of course, what they're able to offer their customers. And if they're going to keep the iPhone as the dominant smartphone globally, they probably do need to be having something in this generative AI space.
Now we have shares of Google parent Alphabet. They're up about 7%. Apple shares, they're up about 2.5%. And sticking with tech, all eyes on Silicon Valley today. NVIDIA kicks off its annual tech conference with opening comments from CEO Jensen Huang. Right now, shares of NVIDIA, they're up about more than 2.5%. And one of NVIDIA's biggest customers joined the S&P 500 today. Shares of server maker Super Microcomputer will have increased more than 12-fold in the past 12 months. We have those shares. They're down actually nearly 3%. And airlines around the world scrambling to respond to reduced deliveries from Boeing. The plane maker focuses on those quality lapses. Bloomberg Intelligence senior aerospace analyst George Ferguson says the real pain might not come until next year.
I think some of the effect on the airlines, especially for summer travel season, will be a bit muted. And I think it's because you're getting your deliveries that you're going to use in the summer by March or April as you get an airplane into your into your schedule. So this whole effect it's going to take a whole year to be felt.
And that will affect airlines like Southwest, United Airlines. We have Boeing shares. They're down more than 1%. That's your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, a good day in the markets here. The S&P 500 up 1%, the NASDAQ up 1.5%. Yields up slightly, 10-year treasuries up about 4.32%. WTI crude oil up just slightly. WTI crude oil, up just slightly, $81.60. And Bitcoin, it's off 2.4%, 66,600. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Lisa, and John. To no one's surprise, President Putin won Russia's national elections. That means 6 more years in power for the man who's already been in charge for nearly a quarter century. Speaking in Moscow, Putin acknowledged there are many tasks ahead, including the continued war in Ukraine. A defiant Putin said Russia won't be stopped from pursuing its goals. Bloomberg News Director for Europe, the Middle East, and Africa, Rosalind Matheson, says it was a clear-cut election result for Putin.
They needed to present a result here that was absolutely resounding, both in terms of the margin of victory and the number of people who turned out to vote. So the turnout figure they needed to present needed to be very high. And in the end, they got very high numbers, around 88% almost of the vote and 74%-ish of the turnout. And that really allows him to reinforce his message that he's seen very much as the leader that people in Russia want.
Putin also says a direct conflict with NATO would be one step away from a full-scale Third World War. President Joe Biden plans to speak today with Israeli Prime Minister Benjamin Netanyahu, according to people familiar with the matter, as the two leaders clash over the war in Gaza. Meanwhile, Israeli troops are inside the Al-Shifa hospital in Gaza looking for Hamas fighters who have regrouped and established a key command center inside the medical complex. IDF spokesman Daniel Hagari.
Our war is against Hamas, not against the people of Gaza. We seek no harm to the civilians that Hamas is hiding behind, which is why we will conduct this operation with caution and care, while ensuring that the hospital continues its important functions.
IDF spokesman Daniel Hagari. Former President Trump is eyeing Paul Manafort for a role in his campaign. The Washington Post reports Trump wants to enlist his former campaign manager he pardoned as a campaign advisor. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Lisa, John.
All right, Michael Barr, thank you so much. We appreciate it. Hey, John, looking at the shares of General Motors year to date, up 13%. Tesla down 30%. Rivian down 50%. Lucid down 35%. Is the old internal combustion engine making a comeback?
I don't think it ever went away, actually. This is like one of those stories I think Matt really should be doing.
Yes.
But range anxiety, the lack of the infrastructure, adequate infrastructure for electric vehicles makes me, if I were to get a new car,
God forbid,
and well, not to say I'm a tree hugger, but I want to save money.
Right.
I would tend toward the hybrid, but I look at the prices of hybrid, and it's just unattainable in the Tucker household.
So we're seeing that. I mean, I guess the stocks here are reflecting, I think, the fundamental concern out there for a lot of investors as they look at the auto space, ICE and EV together, is I still don't have a comfort level as to what the ultimate demand is, at least in the near term, for electric vehicles for the reasons you cited. So I think there's a story out here on the Bloomberg terminal saying a lot of investors are saying, hey, buy the General Motors, buy the Fords, you're going to get the current profitability of the internal combustion engines, which are very profitable for these companies, particularly on the bigger trucks and so on. And you still have the call option on EVs if EVs does play out over time.
And you got to wonder what Elon Musk over at Tesla is going to do, cut prices further, because if he does cut prices further, that is going to affect the cash flow at Tesla.
Yep. It's a kind of a vicious cycle there. And I remember Kevin Tynan, the auto analyst at Bloomberg Intelligence, he said to me years ago at the beginning of the day, at some point, these electric vehicle companies have to start bending metal. And that's a tough thing to do at scale. And I think we're finding that out for some of them here. And again, part of the issue, if not the biggest part of the issue, is what is the ultimate demand for EVs out there? Maybe hybrids is the answer. A lot of folks are suggesting that might be the way to go. So keeping an eye on the auto stocks here. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, John Tucker sitting in for Alex Steele. I'm Paul Sweeney. This is Bloomberg Intelligence. We really try to focus on company news, stock news, and we lean heavily on the 400 research analysts at Bloomberg Intelligence all around the world. We cover 2,000 companies in 130 industries, so you're going to hear a lot from our really smart BI analysts on this show here from 10 to 12 every day. Coming up in this hour, RJ Gallo, Senior Portfolio Manager at Federated Hermes, talked to us about the fixed income market. Herman Chan, Bloomberg Intelligence Senior Analyst for regional banks. What's happening with the regional banks here? Do we have more pain to go here? Shouldn't it be better for them when rates go down? So we're going to talk to him about that. But first, let's go to Mr. Charlie Pellet for Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. Good morning, John. Welcome back, Paul. We've got the Dow, the S&P, NASDAQ solidly in the green right now, and this update is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. A lot of green day after St. Patrick's Day with the S&P right now up 53, higher by 1%. Dow Industrials up 159. That was a gain there of just about 0.4%. The NASDAQ Composite Index now surging 1.6%, up 257 points. The 10-year, 4.32%, with the 2-year this morning, 4.73%. We've got spot gold advancing by 0.1%, 21.58 the ounce. West Texas Intermediate crude at 81.84 barrel, up by 1%. Bitcoin down 1.8%, 67,042 right now on Bitcoin. So it is an up day. As for the overall market backdrop, all eyes will be on Fed Chair Jay Powell. Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets.
I wouldn't say maybe all about the Fed, but I would say maybe mostly about the Fed. So maybe, like 80-90% or so. And, I would say in my conversations the last few weeks, at least I feel like we've got a lot of the angst out of the way. So it's been, the economy is hot. How can the Fed possibly cut? Oh my gosh, there aren't going to be any March cuts. And we've been kind of pushing back saying, well, we never thought there were going to be March cuts to begin with. We've always been looking at June.
Sentiment among home builders climbed to an 8-month high in March as a limited number of existing homes for sale and mortgage rates that are down from their peak spurred demand. Among some of the home building names today, we've got Toll down 0.6%, KB Home down 1.7%, and Lennar down 0.9%. Recapping, S&P higher now by 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. Bloomberg Intelligence. We're streaming live on YouTube, so youtube.com and search Bloomberg Podcasts. And we're also coming to you live from the Bloomberg Interactive Broker Studio. And John, you were asking about a day lift ticket at Park City, and I literally didn't look. I just signed because it was $299 a day.
Whoa!
Thank you. $299.
I remember the old man took all 6 kids, and we were little tykes, to where was it? Vernon Valley, and I don't know what it's called, in New Jersey.
Yep.
And it was pretty expensive then. $6 a lift ticket.
For children, 5 to 12, only 5 to 12, $194.
Whoa!
And then you got to layer in on the ski school for them and the gear. It's the cost is prohibitive. I just, I'm going to say it's prohibitive, but it's probably been this way forever on a relative scale. I don't know, but I just don't know how, middle income families get into the sport of skiing.
Well, they don't.
Yeah, I guess.
They don't.
I guess. I don't know. Tough stuff there. So you asked, but, it was a good day. We had some fun,
Well, you look good. You got your tan.
Exactly.
You're nice and relaxed.
Yeah, exactly. All right, let's check in what's happening with these markets. Another good start to the week here. As Charlie was just reporting, the S&P up 1%, the NASDAQ up 1.5%. Abigail Doolittle, she joins us here in our Bloomberg Interactive Broker Studio. She covers all the markets for us. Abigail, what's getting your attention today?
Yeah, this rally. I mean, as you just mentioned, a nice move up for stocks. That S&P 500 up 1%, and then the NASDAQ 100 up 1.6%. And, it really has to do with Alphabet and Apple, the Bloomberg exclusive from earlier today, that Apple may use Google's Gemini, some of those AI features on its new iPhone operating system. Apparently, they've also been in talks with OpenAI, but this seems to be maybe the favored partnership, maybe having something to do with the fact that they have the partnership around Google going into its Safari on its iPhone and some of its other devices. Google pays them billions of dollars for that. So the Mag 7 today is the Mag 7 because in terms of the point boosts, it's Apple, Alphabet, NVIDIA, Tesla, Meta, Microsoft, and Amazon in that order.
Yep. It's still the tech kind of driving things here.
Yeah, today it is.
Oh, and I'm looking at Super Microcomputer, those shares. Just in terms of the one-day performance in the S&P 500, this is like pretty staggering. So it's just like, and year to date, huge.
Yes.
And they, of course, became a member of the S&P 500, as you mentioned.
Yes, and today a little of that rally coming off down 4%, but within the context of an almost 1,200% rally over the last year. A little
give back.
Yeah, a little give back. Now, there is a bit of a parabolic uptrend there, so it's going to be curious to see whether or not, how much of that holds. I think it's going to have to do at the end of the day, how much revenue do they actually bring in from AI?
Let's just stay on this whole ski theme here because it's just that $299
oh my
ticket
gosh.
here. I'm looking at
that's
Vail Resorts because Vail owns pretty much everything across North America in terms of all the resorts. MTN is the ticker. I was just looking at it. The last 5 years, the stock's up 2-3% versus 14-15% for the S&P 500. So a big underperformer. And then I'm saying $299. That's a lot. But the 5-year average adjusted ROE for this company is kind of like 15-16%.
I'll take it.
Yeah, that's not too bad. I mean, so they're.
I still can't get over the fact that it costs nearly $1,000 for a family of 4 to go skiing.
Yeah,
I mean that's just
now,
unbelievable.
They don't. I mean, in the east here, where conditions vary, like Killington in Vermont, which is my go-to
place.
That's
where I learned how to ski.
Because I can't afford to go out west. But
yes, you can.
They have an amazing infrastructure in terms of making snow, and that's very, very expensive to do. Do they have to do that out west?
At the lower parts of the mountain very early, just at the lower parts of the mountain. I was out there in October and went up to the mountains. I was in Denver in business, went up to the mountains, and probably they had natural snow 80% of the way down the mountain. So all they did was make snow for the bottom 20, and then boom, they're ready to go. But they've invested. But I mean, it's just the cost in terms of the infrastructure, capital costs, and the operating costs are just brutal. But again, looking at the Bloomberg Terminal 5-year average ROE, about 15-16%. So they're doing well in that capital. Anything else there, Abigail?
On the downside, we have, SMCI is actually getting sinking even more as we are talking. It's interesting, though, the rally is so robust today that it seems at this point to be a rising tide for all sectors. All 11 S&P 500 sectors are higher. Not surprisingly, the mega cap tech sectors, the three of them, are the highest. The other thing that I am talking about that I was talking about last hour, yields. We do have the 10-year yield up 2 basis points. The 2-year yield sort of flattish, but of course the big event for this week is the Fed meeting on Wednesday. It's largely expected that they're not going to be making any changes to interest rates, but will there be any color in the policy statement or in the press conference about how many cuts? Right now they're talking about 3. The street is talking about 3. I think there's agreed upon that it could start in June. If there's any sense that it's not going to be 3, it's not going to be this year, it's not going to start in June, I think we could see a pretty interesting repricing for risk, which would mean yields up, stocks down.
Yep, absolutely. All right, Abigail, thanks so much. We appreciate that. Abigail Doolittle, she covers all the markets for Bloomberg. And John Killington, daily lift ticket, adult, 18 to 64, $189.
Yeah, no,
So
believe me, I know.
Yeah, something a lot less than going out west, but maybe you get bang for your buck. But yeah, it's just, it's incredible. And I don't know if that's a long-term fundamental challenge for the industry. I don't know how they address that.
Well, it's climate change. This is like, what are you going to do? It's just like...
Exactly. And there's a story on the Bloomberg Terminal that people that usually ski the Alps, they're going up to Scandinavia now, that just to find the snow. So anyway, let's talk fixed income, shall we? Let's go from skiing to the bond market. RJ Gallo, he can do that. Senior portfolio manager for fixed income at Federated Hermes, joining us via Zoom here. Hey, RJ, since the last time we spoke to you, yields are moving higher here. I guess the market's kind of losing its enthusiasm for, I guess, aggressive rate cutting. What do you make of this market?
Well, it's good to see you again on YouTube. I would say that the market ended 2023, which seems like quite a while ago, but it wasn't that long ago when the markets were priced for almost 7 eases in the calendar 2024, and the markets had just gotten way ahead of themselves. There was excessive confidence at the time that the dovish tone of the December FOMC meeting opened the door for the following argument. Inflation will continue to fall. Therefore, the Fed must ease nominal rate targets so that real policy rates, don't inadvertently or undesirably rise. For that to work, you needed inflation to continue to fall. And that just hasn't happened. The inflation data has been sticky or buoyant at well above target levels. The economic data, both jobs and growth data, have been pretty good. Not as good maybe as some prior quarters that were stronger, but still nowhere near probably a sufficient slowdown to get the Fed to be concerned that we're heading towards a harder landing or something. So since the data didn't cooperate with the argument that the Fed had to ease to prevent real rates from rising, the Fed didn't have to ease. And that came out of the markets. Now we've got a little less than 3 eases priced in cumulatively up until the December 2024 meeting. Very consistent with the Fed's dots, just in time for the dots to maybe change.
Okay, you got to explain to the dummies out there, including me, the real rate, just how significant that is in terms of doing some or all of the heavy lifting.
It's a good question. Real rate, simply take a nominal yield or a nominal rate target, use the upper end of the Fed funds range right now at 550, and subtract off a 4% inflation rate, you've got a 1.5% real rate. If you subtract off a 3%, you got a 2.5% real rate. If inflation keeps going down to 2, and you don't move your 550 upper end of your Fed funds target, the Fed now has would end up having in that scenario a 3.5% real Fed funds rate. That's historically pretty high. That's the kind of constrictive or restrictive policy that could precipitate a real economic downturn, a recession that the Fed doesn't want. But again, they don't need to move. If inflation itself is stuck in the 3s, generally looking whether at the CPI or the or the PCE deflator, then the Fed might not need to be in such a rush to reduce nominal rates to prevent that real rate from rising. Secondly, I think it's important to note that the Fed doesn't really know where the equilibrium Fed funds rate is. The long-term dot, and of course we're going to get updates on the dots this week, is at 2.5%. The market, if you look at SOFR futures out 3 to 5 years, the market seems to think that the long-run equilibrium Fed funds rate is more like 3.5 or 3.7 maybe. So the Fed isn't going to ease based upon a model if the data is still strong, labor market's tight, and inflation not falling rapidly.
All right, so RJ, given that kind of background, how are you positioning your portfolio? What are you telling your teams to really look for?
Sure. So first of all, looking at sort of the different levers that an active manager, which is what we are, can do in a fixed income portfolio. On duration, once the market started to get sort of disabused of the notion that we were going to get 7 eases, we waded in and took a tactical long at times. We've gone back to neutral. We went back to neutral before the most recent sell-off. We took a little bit of profits on what we had as a very temporary long position. So that's worked. We're at neutral now. Heading into the FOMC meeting, we're apt to stay there. I think there is some risk that the Fed will move the dots up a little bit. Abigail was mentioning that could be a challenge for risk assets. We think that could be a challenge for rates too, give a little lift to the rates market. So that's on the duration front. On other levers that we can push and pull in fixed income, when it comes to credit sector allocation, we're overweight mortgages. We think they still look cheap. We like the extra carry they're giving us. We're much more cautious and underweight high yield corporates. We think that the spreads are very tight there. Compensation for the risk isn't so great. Default risk still rising incrementally. That's not to say that we're underweight high yield because we think a recession's coming. It's really a question of valuation and compensation for risk at the current levels. We're a little more constructive on IG. Yes, we're a little underweight, but not as much so. And we've added to emerging markets. I think it's true that the market's base case of a soft landing has become more compelling. If the Fed walks back, easing expectations aggressively, then I think that could be a challenge for risk assets, and it would start to raise questions about whether or not the Fed can ease into that soft landing. We think the Fed is going to continue to signal easing, just less than they have been, and it's quite possible that they might reconsider the long-run dot. Right now, with the way the markets are priced, that might be an opportunity for them to walk through that door and maybe move it from 250 median, maybe a little higher, 275 or something like that. So we're watching that. More of an academic exercise maybe, but that affects expectations in the market.
Why has the last mile been so difficult to get to the target?
I think the inflation problem, which was so challenging, which caused the Fed to completely abandon the transitory argument and get very aggressive, historically aggressive in the pace of tightening. That inflation was born of a surge in aggregate demand amid numerous supply problems, supply shocks, supply chain kinks, inadequate labor supply. So when demand rose for many things coming out of the pandemic, especially services, travel, other things like that, and we had such constrained supply, including labor supply, the only answer in any normal economic model is price must rise to invite entry, to get people back to work, to get firms to work out the kinks. So that supply response is the first order aspect of the improvement that brought the inflation down. That has been addressed. Now I think we're in a world where inflation expectations are relatively well contained and benign, and that's because the Fed acted as aggressively as they did. Had they not done so, inflation expectations might have really surged. This last mile of getting inflation back to target is tougher. We have a better functioning economy. We have a tight labor market. Sort of more traditional non-dislocation models of economics would suggest that maybe the economy does need to slow down in order to get inflation to continue to fall. Right. The argument that the first mile was successful on supply is very true, but the last mile might require more of a slowdown, and that suggests the Fed might not ease as aggressively as once thought.
Yep. All right, RJ, great stuff as always. Really appreciate getting some of your time. RJ Gallo, he's a senior portfolio manager at Federated Hermes, joining us via Zoom. Just going back to Vail Resorts Mountain, they have about a 30% EBITDA margin, so pretty profitable day to day.
You're in on this.
I'm in. They spend about $250 million a year on capital expenditures. That's a lot. It's a lot of new lifts and stuff. But they still generate close to $500 million of free cash flow. So pretty profitable business.
As
what
long
you get
as
for
it keeps
$299 a
snowing.
ticket. Exactly. As long as it still snows. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index all pushing higher. The Russell 2000, though, kicking off the week with losses. Lower little change, down by about 0.2%. But to put that in context, we've got the S&P up now by 1%, higher by 50 points. Dow Industrials up 170 now, up 0.4%. NASDAQ up 220, a gain there of 1.4%. The 10-year yield, 4.32%, with a 2-year right now, 4.73%. Spot gold up 0.2%, 21.60 the ounce. West Texas Intermediate crude oil up 1%, 86.17 a barrel. Bitcoin now down 2.2%, 66,791 on Bitcoin. Elon Musk says his ketamine prescription alleviates periods of low mood and is in the best interest of investors in Tesla and other companies he runs. Speaking in an interview with former CNN anchor Don Lemon, streamed on YouTube, Musk said, "For Wall Street, what matters is execution." He says, if from an investor standpoint, if there is something I'm taking, we should keep taking it, he said, referring to Tesla's success. Today, Tesla shares, they're surging now by 6.6%. Again, recapping, stocks higher, S&P up 50, up 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. John Tucker and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so just head over to YouTube on the internet, I think they call it, youtube.com, and search Bloomberg Podcasts. NYCB, New York Community Bank, down another 7.5% today, down 65% year to date. Is it an NYCB problem, or do we have some more systemic problems for some of the regional banks? For that, we turn to Herman Chan. He covers all the regional banks for Bloomberg Intelligence. Let's start first, Herman, with, and he joins us here in our studio. NYCB, what's the news today pushing the stock down?
Yeah, so NYCB caught an analyst downgrade earlier this morning. It cited ongoing credit issues with potential losses in rent-regulated apartment commercial real estate, really hampering the earnings power for the bank.
So let's get back to the 40,000-foot view.
Mm-hmm.
The smaller banks, like New York Community Bank, in trouble because of real estate, whether it be commercial or other types of housing.
Right.
Explain how that all works. They lend out money to a building, a commercial real estate, and looks like they don't have tenants anymore.
Right.
So the loan doesn't get paid back, or what?
Yeah, that's right.
Talk to me like I'm your German Shepherd.
So there's two issues. You can look at all these Class B and C type office buildings here in New York City as a good example, where the work from home phenomenon has left has not brought a lot of cash flow in for these owners of these properties, right? Because some tenants are leaving, there's retail space that's leaving, so that's exacerbated some of the issues with cash flows for these borrowers as they refinance over the next few years. And you've seen that already, where higher interest rates and the lower cash flows is a bit of a double whammy for them. So it's harder to refinance, and they don't have a lot of cash coming in, so it's difficult to repay these loans.
And in some circumstances, they just walk away from the building?
There's some circumstances that we've seen, like larger property owners like Brookfield and Blackstone have walked away from buildings that just aren't tenable anymore. If they didn't walk away, there would be more losses going forward. So they make a calculation and say, we're giving the keys back because it's better for us economically to do that rather than supporting this building that has weak cash flows.
So I'm looking at the Spider S&P Regional Banking ETF. It's off 1% today, off 9% year to date, but up 13% from a trailing 12-month basis. So they did kind of come off the very, very bottom, I guess. Is NYCB, it sounds to me, it's specific to NYCB.
Right.
Okay.
Right.
Now, but on the flip side, I also understand from smart people like you that if to the extent there is commercial real estate exposure, it is primarily with small and mid-sized lenders as opposed to JP Morgan's or the Bank of America's of the world.
That's right.
Okay,
so there's two issues that we have pointed to in our research. The actual office and commercial real estate exposures for the largest banks like JP Morgan, and you can throw in the largest regional banks like a U.S. Bank, PNC, Truist, Fifth Third, et cetera. Their exposure to commercial real estate is much smaller compared to smaller regionals and community banks. And growth in commercial real estate since the pandemic has been largely focused on the smaller banks. And for the largest U.S. banks, it's grown about 2 or 3% since the pandemic, whereas it's upwards of 20% for a lot of the smaller banks. So the concentration risk is more focused on the smaller banks. And you've seen that dovetail nicely if you compare the performance of the BKX, which is the index for the largest banks, versus the KRE, which is the index for the regional banks as a whole. There's been a divergence over the past year to date.
So as the situation gets worse, do the regulators who oversee the banks, do they increase the regulation, therefore making the situations spiral even further?
What you've seen some tougher regulations, at least proposals, come out since the SVB, First Republic signature failures last March. And that's still going through, the sausage-making process at the Federal Reserve. And there's been pushback by the largest banks because they think the regulations are too onerous. So and Chair Powell has talked about saying that as it's currently proposed, it may not pass muster for the Fed. So there's not 100% buy-in from the top of the Fed. So that means that there could potentially be some watering down of those regulations.
So if I'm an analyst, is it fairly easy for me to look at a bank and say how much commercial real estate or how much maybe office real estate exposure it has vis-a-vis everybody else? Mm-hmm. And I can mark that stock down or up accordingly. Aren't we already there?
Yeah, we are. I think we've seen that in the trading action since NYCB reported their fourth quarter results that really surprised the street, that the industry's been pretty resilient, and I think everybody has started to realize that not every office and not every apartment lender is the same, and so there's been more discerning trading for a lot of these regional banks, which is good because last March it was all regional banks are going to fail, and now we're not in that sort of scenario any longer.
Last we heard, it was Steve Mnuchin to the rescue with $1 billion from other investors.
Oh, that's right.
Where's that stand, and is $1 billion enough for?
Yeah, that's the ultimate question, right? So the $1 billion injection, capital injection, really instilled a bit more confidence in the bank. It brings their capital ratios back to peer levels after the loss in the fourth quarter. It gives them some room to build up their bad debt reserves for future loan losses in their apartment lending business. But is it enough? It's still up in the air. The downgrade from an analyst today pointed to there's going to be credit losses, and there's a lot of uncertainty with their earnings power because there's going to be higher expenses. Their margin's going to be compressed over the next several quarters, and they're not going to grow their loan portfolio. They're actually shrinking it. So still lots of questions, and really it will depend on where interest rates go and how their credit quality holds up, and not a lot of answers at this point.
So for the quality smaller regional sized banks, is there smart buying in those things at the moment? Longer term buying, or just that trade off the bottom? Or
yeah, I think you've seen some stability for a lot of the banks, the smaller ones that still have room to perform and outperform with credit quality is going to be the key. Not the bank investors aren't really focused on growing the balance sheet at this point. It's more, do you